$78 handle now, 78.73, so up again, up for a second day. Yesterday we saw gains in the end, even if we started out with some negativity around the oil story. So geopolitics really rubbing up against concerns around the global demand story for the oil price. This is the futures picture for European equity markets. Then we are expecting, well, I was going to say a positive start to trade. These futures fading just a little as we get closer to the start of the trading day, but we were expecting to see something tentatively positive given that US futures had been improving and the session in Asia had been turning around just a little bit. So let's see what we get here. This is the picture for European stocks then. At the start of trade, we just have the London market open, so we'll give that column a little time to settle down for some other equity markets to join the fray. I just want to draw attention to the euro here, up by 0.01% on the euro, and this is the same trade I was talking about in terms of the positivity around sovereign bonds. So you see the French 2-year, the German 2-year, Italian, Spain. So across the board, really, we are seeing buying of sovereign bonds, those yields coming down, and that getting some comfort, I suppose, from the month-on-month data from North Rhine-Westphalia and from the French CPI. We're building a picture through the day of the European inflation story. As Mark was telling us, that narrative around disinflation pretty intense and well established for Europe. And so it's going to take quite a lot to knock that. And we certainly don't see anything that knocks that just yet this morning. The pound also making some gains, up around 0.2%. Here's the moves higher that we were talking about in commodities. Certainly I quoted Brent. I could also have mentioned the gas price because we're seeing that tick up just a little. Even that's though off its highs of earlier. We were up by more than 5% at the very start of the European trading day for gas prices. So back to equities, and we're slightly positive actually. So maybe the futures picture was a little misleading there. FTSE futures up by 0.4%. We also see the French market recovering a little from those heavy losses of yesterday. We saw the likes of LVMH and Alstom hit by broker reports yesterday. So we see both of those markets doing okay this morning, making some modest gains. Let's have a look at the sector picture then. So overall, it's a story of tentative positivity, up by 0.4%. And most of these sectors then in positive territory. I can see basic resources is one area that we're seeing particular strength coming through. Also, healthcare stocks doing pretty well, and energy as well. So the second day of gains for oil prices perhaps helping there. Consumer goods, though, seems to be a negative. Interesting to see how retail is performing, given what we heard from the likes of JD Sports and Next, a conflicting picture of the holiday period being painted there by those retailers. So that's the start of the European trading day. Let's talk to Sophia Horta-Acosta from our Markets Today blog, who can talk us through some of the market moves we're seeing this morning. And Sophia, it's probably important to start with the big picture macro dynamics coming through from the United States. We had, of course, a bit of volatility created by those Fed minutes, and they're talking about restrictive policy needing to stay in place for some time. Of course, how long some time is a question. Does that mean until March? Does it mean until May? Does it mean later in the year? What is your takeaway from those Fed minutes?
I think that's exactly it, Anna. And does it mean when the data finally starts to really reinforce the case for Fed cuts? I think the key discussion around Fed cuts is why the Fed will cut. Is it because you are seeing the disinflation narrative really become increasingly obvious, so obvious that even the Fed can't deny it? Or is it because we're going to start seeing softening in the data and a soft landing? You know, a lot of, much of Wall Street is expecting a soft landing scenario. That's the outlook for 2024. Obviously, there's a risk to that when everyone expects the same thing. Anything that kind of trips up that narrative could be potentially disruptive and increase volatility. But again, the Fed minutes, I do think central banks are trying to push hard. I think the Fed is not pushing as hard against rate cut bets as the ECB and as the BOE, but fighting against the market, against those interest rate cuts, those bets that are really building up in the market. I think it will be very, very difficult, especially when the data reinforces the case, Anna.
Sophia, let's pivot our attention to China, and that's because, you know, before you were here, you were there, and as Mark was saying, you focused on Chinese markets, and so we often like to get your thoughts on what's going on in China. Now, valuations and saying that China is cheap seems to have been something that investors have been saying for a very long time, but you think that turns into a different market narrative this year. Why this year? What's different?
So I think this time last year, and absolutely everyone was bullish on China. There was a very obvious, easy macro trade. That's what people were saying, the reopening of the economy. And the problem is when that kind of failed to impress, when the economic data didn't show that we were having the post-reopening boom that we had in the US and Europe, that was really disappointing. Then it reinforced a negative bias in the market where absolutely nothing would be enough to get people really investing in China again. Now we're in the very, very opposite market sentiment because it's so negative. Valuations are a record low versus the rest of the world, and it's just a flow story. The kind of big China unwind is already behind us. Most long onlys have left. Even EM dedicated funds are looking at India, looking at Indonesia. So it doesn't really take much to even like just a trickle of that money coming back. When the MSCI China Index has lagged the rest of the world for 3 straight years, that's the most since 2001. It really doesn't take it doesn't take much for that change in sentiment to drive some of that money back. The problem is, Anna, no one has the courage to do so. So even though investors want to, even though there's a valuation case for it, you need to start seeing flows coming back. And I think that will start locally with Chinese investors.
Yeah, I mean, you just have to wonder whether any of it matters, the valuation matters, or any of the other dynamics around China matter, if the role that China plays in the global economy is being so questioned right now. And that might not be changing right here, right now, in the moment. I mean, it is changing at the margin, but it might not be wholesale changing. But what it suggests for the future, for the Chinese growth engine that we've known over recent decades, it might not be the same as that anymore. Both because it's grown so far and also because of, crucially, the geopolitics. You just wonder if it's so structurally different, what difference does the cheap valuation make?
Yes, exactly. And people are starting to look at China differently because there's been a reassessment of the role that China plays in the global economy. And China used to be the high growth story, right? It's no longer that. Even 5% GDP growth this year is seen to be probably what the government is going to target, no longer double digits. So changing the way the world thinks about China in that way and the geopolitical side of things is an important kind of reassessment of how you invest in China. I do think a lot of funds just don't bother anymore. I think the big theme of last year was not only a kind of a unwind of China positions, but a growing disinterest in China, and people were looking for alternatives to investing in China. But it is so big, and the thing with China is with Chinese markets is when they do recover, they tend to recover quite rapidly. So I'm not saying this is going to be a volatile market. This is not an easy trade. It's not a market for long only funds to stay in China and to buy and hold. It's as I wrote in the Outlook, it's a playground for the fast money, and I think that's the big reversal technical trade of 2024. That's where people could start to look, maybe.
Okay, Sophia, thanks very much. Sophia Halter-Acosta from our Markets Today blog with a look at the global macro trends post-Fed minutes and also a deep dive into the Chinese stock market case. You can get more from the blog team. Go to the Bloomberg UK website, or you can type TLIV GO on the Bloomberg terminal. Coming up on the programme, the Fed agreed to maintain a restrictive stance for some time, but for how long can they hold off cutting rates? More on this story. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah,
New
the
York City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
This is Markets Today. We are 10 minutes into our European trading day, and European equity markets actually doing okay this morning, trading higher by around 0.5% on the Stoxx 600. The FTSE up by 0.4%. The CAC 40 up by 0.4 and rebounding from some of those losses of yesterday. Let's get a check on the individual stocks that are on the move. Joe Easton back with us with a briefing. Joe.
So we've got an absolutely huge move in JD Sports at the moment here in London, down 17% in the opening of trading. This is the biggest drop for the stock since the outbreak of the COVID-19 pandemic back in March 2020. The company warning that consumers are more cautious, and the key trading period over Christmas has been below expectations, missing analyst estimates by around £100 million for the full year forecast on that one. Next, though, looking much more positive, up 5% at the moment, much more UK focused, doesn't have the US exposure. They are saying that their full price sales over Christmas were higher than they had predicted and not doing as much promotional activity, according to them. One stock we haven't kept yet is Topps Tiles, not covered this one down 9%. They have warned that sales have fallen 7% in the last period in terms of the quarterly results for them. It's flooring companies as well. A good opportunity for puns, of course. Investors not exactly floored by that one. Won't be on the tiles tonight for Topps Tiles, getting in some bad puns. But take a look at Adidas. Moving on from that, Adidas potentially a read across from JD Sports. JD Sports, of course, selling a lot of Adidas and Nike products as well. We're also seeing Puma as well. Both of those dropping in Germany in terms of Adidas and Puma. So keep an eye on all of the sports stocks today. In terms of Evertech, which was another big one, we expected that one to drop, and we're seeing a huge move in that stock in Germany, down 16% at the moment. The CEO announcing his resignation, a surprise move from him, 15 years at the helm. A bit of a compliment for him with the stock falling as much as that one is at the moment. AP Immerse, now this one has a couple of different broker moves coming out at the moment. JP Morgan is downgrading, saying that the recent rise in shipping rates is overdone and that won't boost the stock as much as some investors had expected. So that one's still gaining around 2% at the moment. We had Equinor and BP. They were in stocks to watch. They've cancelled a big contract for offshore wind over in New York. Now that one is helping those stocks, but of course benefiting as well from the higher oil price, given those geopolitical concerns over in Libya and the other OPEC headlines we've been seeing. So those ones coming up with the oil price as well. In terms of a couple of other ratings moves, we got Tullow Oil and also Enquest cut at Jefferies, and in the pharma space, Grifols gets an upgrade at Barclays, and finally ING, we're hearing a broker move over at Bank of America, falling 3% in Amsterdam.
Thank you very much. Thanks for that, Joe Easton, joining us there from our equities team with a look at some of the stocks that are on the move this morning. So 13 minutes into our European trading day, let us move on to another conversation this morning. I'm pleased to say that we're joined by Hetal Mehta, Head of Economic Research at St James's Place, and she can talk us through her thinking this morning. Hetal, nice to speak to you. Let me talk to you about the Fed then, first off. Let's start with our conversation with what's going on at the Fed. Now, we've had this narrative from the Fed coming out of the minutes that basically leads to the conclusion that rates do remain elevated for longer, but the market seems pretty convinced by the dovish pivot from December for the moment. Did anything new come out to you in the minutes?
There wasn't that much new, I think. Some of the early conversations maybe about QT, maybe a slight surprise at this stage. But I think the main message was that the minutes are still consistent with everything that we heard from Powell earlier in December, and I still think that the message that they're giving is probably a kind of premature dovish message given where inflation is.
Okay, do you think it's premature? You see, if the lot's been made of the fact that the Fed quoted in its minutes the 6-month PCE, which actually is already, the core number is down at 1.9%. So I suppose if that's what you're looking at, if that's the inflation target that you have in mind, you could argue that the inflation job is done.
Yeah, I understand that, but you have to look at a broad range of measures. And when you look at the labour market, and we had the JOLTS data yesterday showing a very mild cooling, but the labour market is still really tight. And obviously we've got payrolls coming out tomorrow as well, which will be a big focus. But there are still more people there are more jobs than there are people to fill them. So, I mean, it's a super tight labour market, tighter than it was even pre-COVID. And I think the inflation risks from wages is still quite present. And I think it's probably a bit too early to be signalling, or at least validating the market expectations of rate cuts as early as March.
Right, so there's a risk that wages tick up again, you think, perhaps, Hetal, and where does that leave you in terms of expectations of the first cut? It seems expectations for March have been dialed back a little from this was happening even before we saw the minutes, but certainly since the start of this year, expectations dialing back a little bit for that March cut, but maybe investors settling on May. When do you think we get that first cut?
I'd be surprised if it was before the summer, to be honest. I think sometime in the summer, late summer, would be more appropriate. Obviously, it gets tricky as we approach the election. So there's maybe some reason that if they're confident that inflation has fallen enough, that they start a bit earlier. But from a purely economics perspective, I would say that midsummer is actually probably more appropriate.
So how do you characterise the US economy at this point then? I mean, a lot of people underestimated the resilience of it last year. A lot of people now talking about maybe it's in some sort of Goldilocks, or a slightly more negative take might be a soft landing. Where do you see the US economy coming through here?
We're actually really kind of in the middle. We kind of see this phase of kind of muddling through. Growth kind of hovers around zero. There are plenty of people who will say that the US is still heading for a recession. I mean, define recession. Tiny technical recession is not really going to cut it in my book. You have to see meaningful pickup in unemployment. I don't think we're going to see that. I think we're just going to see a period of stagnation, very small uptick in unemployment, which keeps that inflation pressure going down. And that's the point at which I think it's appropriate for the Fed to cut. But I think overall it's a kind of muddle through scenario.
And what about the UK then? But how would you characterise the story there? Because although I was reading some research earlier, Bloomberg Economics talking about how they see it, it's likely that we get a technical recession, but they say that actually the bigger picture for 2024 is brightening because inflation has been coming down faster than many had anticipated. So how do you characterise the UK?
So I think the UK's got two different things going on. One, inflation is still much higher. So the kind of support that we might anticipate from the Bank of England coming through, I think will be even more delayed than what we might expect from the Fed. The overall economic picture, I agree, in terms of wages, real wages will start turning positive, and that will help. But actually, I just think that it's probably even closer to stagnation, and it's overall, I still think it's a weaker picture than the US.
Okay, so a weaker picture than the US. And what interests you about the UK story right now? What are you watching? I was looking at some of the data points still ahead. I mean, are you focused on mortgages? Because what that will tell us about the struggles that some people, homeowners, whatever proportion of the UK economy that is, they're going to face on remortgaging. I mean, where are you focusing, Hessel, to get clues about where we go next?
So the mortgage market's key. I mean, it's actually only about a third of households have a mortgage, so nowhere near as much as it was in the past, and so many are fixed rate. But that's why the impact of rate rises that we've seen to date, I think, is still to come through. Even by the Bank of England's own assessment, they're only halfway through in terms of the interest rate pass-through. So all of the savers have had the pass-through in terms of higher rates, and that's probably helped that resilience through the course of this year. I think some of the mortgage pain is still to come, and we heard earlier that consumers are going to be cautious, and I would agree with that.
So with that in mind then, and if we have to wait longer for support from the Bank of England, you said the summer for the Fed, so does that mean later in the summer for the BOE or later still?
Yeah, I mean, I would have maybe said third quarter, fourth quarter, something around that. I mean, we had a good surprise on inflation last month. You know, it started to come down a bit faster than the bank might have expected. So maybe it pulls it forward a touch. But yeah, definitely safely in that kind of second half.
Okay, Hessel, thank you very much. Thanks for joining us. Hessel Mehta, Head of Economic Research at St James's Place. Coming up on the programme, trade tensions and national security rules in China are prompting US and European banks to ring-fence their operations in the country. Will this help to minimise risk? We'll bring you that important conversation, that big take story around the changing role of China for Wall Street. We'll bring you that next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets Today. We're 23 minutes into our European trading day and making decent gains across European equity markets. This morning, then, the Stoxx 600 up by 0.4% as US futures also gain a fraction. Let's talk about our big take story for today. A Bloomberg investigation has found that US and European banks are, quote, ring-fencing their operations in China on a scale rarely seen in modern international finance. Let's get more details on today's Bloomberg big take story with one of the authors, senior reporter Kathy Chan, who joins us now on set here in London. Kathy, good morning to you. So let's start with what the ring fencing, what this means. What prompted the ring fencing? Why are these banks taking a different attitude to China?
Yeah, it's really the heightened tensions between US and China, two biggest economies in the world, as well as the data rules in China announced since 2021, which is really costing the banks tons of millions of money just to segregate the financial data, client data, even employees' data onshore from the rest of the global operations. So the banks are also genuinely worried about the tensions over trade, over Taiwan. That could someday worsen quickly. So in some extreme cases, if China got sanctioned completely by US, what will happen? So all these are endangering the bank's ability to manage their subsidiaries in China or kind of like operate those subsidiaries effectively.
Okay, and you sort of alluded there to some of the measures that have been put in place, some of the specifics around ring fencing. You were talking about where data is located, for example. So what are the measures that we've seen these banks putting in place?
These measures are actually taken kind of slowly and quietly, and because they are sort of like come out from the behind-the-scenes machinations and deliberations of the banks. Morgan Stanley, more obvious when they relocated 200 software engineers from the mainland because they need to provide, they need to kind of set up a separate IT system, which is completely incompatible with the global system. That's one example. We are seeing some banks already adopted using the local surveillance system, anti-money laundering software made in China as they continue to phase out or stop using the cloud-based foreign branded software in China. That's another example. And you will see banks not only decouple the IT system, they could eventually decouple the balance sheets from China and in China from the rest of the world because the data law is really hampering the visibility on the mainland in terms of the risk they're taking onshore.
Yes, and I know the story makes the point that one of the Wall Street banks that you've talked to for this story, we've actually seen them stopping briefing the head of their subsidiary in mainland China on sensitive company strategy because they don't want the Chinese government to eavesdrop on what's being said. Right. So what does this mean then for these Wall Street firms in China?
Wall Street firms in China is no longer pursuing the China dream. The dream is sputtering. Right now, what they're doing is to mitigate risk as much as they can, protect the onshore operations, protect the global reputation, minimize the risk in China, having a very rigorous and sort of like frequent risk assessment on the country's potential because given the economic stagnation there, the data laws and also the policy flip-flopping, it's really risky to operate China by spending a lot of money. The data regime is already costing a lot of money and it's consuming a lot of their budget, which has a knock-on impact already on anything else they want to do onshore. So if you don't see visibility in the country, you will just do less of it.
Okay, thanks very much. So no longer pursuing the China dream. Kathy, thanks very much. Our Bloomberg senior reporter, Kathy Chan, bringing us that big take story. Coming up on the programme, we unpack BlackRock's thematic outlook for the year ahead. We'll talk energy transition and some of the other ideas in focus over at BlackRock. Evie Hambro joins us, head of thematics at BlackRock. That conversation coming up shortly. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. This is Markets Today. We're 30 minutes into our European trading day. Let's get to your top stories. European equities are making cautious gains. The two-year Treasury yield is falling as Fed minutes suggested the possibility of slowing the pace of quantitative tightening. European inflation is in focus. French CPI ticks higher with Germany's data expected to follow suit. We discuss whether it will move the dial for the ECB. Plus, a tale of two retailers. JD Sports shares sink after the UK store issues a profit warning. Meanwhile, the next fashion chain raises its forecast for the 5th time since June. It is the biggest gainer on the Stoxx 600. Welcome back to the program, everybody. So just gone 8:30 here in London. Let's check on where we are across these European equity markets. And you can see modest gains coming through across Europe. Stoxx 600 up by 0.3%, slightly less than that on the London market. But decent gains coming through on the periphery. The IBEX over in Spain in particular up by around 0.75%. So broadly speaking, some positivity. US futures also recovering from earlier losses. So up 0.1% on E-minis. NASDAQ futures up by 0.2% too. And we saw a bit of a turnaround in sentiment through the Asia session. Let's have a look at what we've got on the sectors picture as we remind ourselves retail certainly very much in focus, the travails of JD Sports, but the positivity around Next, all of that coming together to influence consumer stocks. Actually, consumer is a fairly flat sector. It appears on in red on the far right-hand side of that ball, but it is fairly flat actually. Food in negative territory, but only just. Personal consumer goods down 0.2%. So those sectors that are falling, not falling by much, and European stocks overall up by 0.3%. We see some positivity around energy names and basic resources. So both of those sectors up by more than 0.5% this morning. Thinking of basic resources, that features in our next conversation. A new report says resource security, technological acceleration and election uncertainty are set to drive markets over the next 12 months. That is one of the key findings from BlackRock's Thematic Research Investment Group. It makes the case for a focus on quality and selectivity in 2024 and has come up with 3 themes to invest around. Let's talk to Evie Hambro about those 3 themes, Global Head of Thematic and Sector-Based Investing at BlackRock Fundamental Equities. Evie, very nice to speak to you. And let's dive right into it then. These thematics, the thematic outlook for 2024. One of these is around securing transition resources. And I know that's something we've talked to you about quite frequently in the past. And this is all about making sure that the supplies that we need for the energy transition are in place and are accessible and in the right geographies and ones we can access. How far does this theme go in 2024, given it's a theme we've already played, I suppose, to some degree, Evie?
Yeah, well, good morning, Anna, and Happy New Year. I think last year was a year where I guess investors were distracted from the theme. They were focused on the change in interest rates, some of the macro issues that the world was facing, the prospect of inflation as well, geopolitical tensions and so on. But whilst all of this distraction was taking place, we actually saw some pretty substantial news flow across many of the key commodities attached to the transition. And the one that springs to mind the most is copper, where we've had one of the world's biggest copper mines has had to be closed because of tensions within the country of Panama. That accounts for 1.5% of world supply. And then in addition to that, we've had a number of updates from companies talking about the production prospects for their existing portfolio, and I guess the growth that they were planning to deliver over the next few years. And by and large, this has not just disappointed, but substantially disappointed. We've had very significant production downgrades relative to expectations. So whilst the market has been looking elsewhere and been focused on other topics, the situation has become tighter. It's actually become a little bit more scary in a way, because some of the kind of long expected growth is unlikely to arrive in time. And if we do see some kind of shift in interest rates, we see I guess a more accommodative kind of macro environment for monetary policy, then growth is likely to be a little bit better than expected. It appears to us that China is starting to focus on what it can do to support its economy. That obviously is the world's largest commodity consumer. And so with markets as tight as they are, that production disappointing, geopolitical risks attached to resource assets, the supply available for the transition itself is going to be a challenge.
And you mentioned the issues around copper, but there are also geopolitical issues around access to raw materials. And so one of the things that this theme encapsulates is reshoring, or at least friendshoring, but sometimes that might not be possible if these materials are just not available in geographies with whom you're friendly. Where are the biggest concerns on that front?
Yeah, I mean, we've seen some tensions last year, and some of these tensions have been at the fringe on the commodity markets, not the mainstream. So we've seen China put in place restrictions around a commodity called gallium, which is not something that everybody thinks about every day, but you use without knowing. China's recently put in place some import tariffs on coal from certain countries as well. So there are measures out there that are kind of impacting global trade. But I think the point you make around reshoring was very prevalent in in last year. We saw a huge divergence in performance across the steel sector. U.S. steel names were incredibly strong. We saw lots of M&A in the U.S. steel space as well. Whereas in Europe, it was a much more muted environment. And so that kind of the trend around reshoring, domestic investment, the growth in infrastructure attached to that was more prevalent in one economy than another. I think as we move through this kind of energy transition environment that we're expecting between now and middle of next decade, we're going to see strong demand for commodities to support the transition across the global picture. It's not going to be a one country event like we saw with the China cycle in commodities in the early 2000s.
Okay, so volatility perhaps created by some of the geopolitics, maybe also created by some of the election activity that we have taking place in so many countries, 40 or so this year in 2024, in very contrasting geographies. So to kind of navigate that volatility, you're talking about investing in quality and companies that have pricing power. I feel like pricing power ever since the pandemic has been one of the themes that people have wanted to talk about. What sets it apart in 2024?
I don't think anything sets it apart. I just think it's a constant theme that people should be focused on. Obviously we've seen pricing power create a lot of dispersion in returns in relation to the inflation environment that we've been in. Those companies that have been best positioned to be able to pass on price increases that reflect their own cost of goods increases have actually performed the best. And so that pricing power element has always been an essential component of returns, and I don't think that's going to go away. In the context of elections, you mentioned it, this year is going to be a massive year for elections. We've got huge amounts of the world's population being exposed to them, and some very, very big events. And I think many of them are far too hard to call. So rather than me speculate on something that's going to be a long way into the future in this year, I just think it's something that everyone has to be aware of.
Yeah, and that can create volatility. Something else that we are very acutely aware of in 2023 has been some standout themes around European corporates or global corporates. So on the European side, thinking about healthcare and obesity drugs. On the US side, thinking about artificial intelligence. I suppose commercializing these new technologies is going to be a real key theme of 2024.
Yes, I mean, some of these things are very visible, you know, and I think when we think about thematic investing, the things that tend to resonate the most with investors are things that you can actually, you know, reach out and touch. You know, when we first came to talk to you about our involvement in the change in mobility and electric vehicles, you know, everyone was saying, well, you know, how are we going to get access to these cars? We can't see them on the street. You know, how are we going to charge them? There's nowhere to charge them. You know, fast forward to today, and they are everywhere. Charging points are everywhere. The growth is way ahead of expectations.
Not enough still, maybe, Evie. Speaking from my personal experience.
Probably not. But you know, these things have a habit of getting to an inflection point. And once they get to that inflection point, then they really take off in terms of market share. And I think we're starting to see the same coming through with things like AI. You know, AI was a dominant theme last year. You talk about the obesity drugs. You know, these things are definitely past that inflection point. And if we do get that kind of stratospheric move, then you know, that's something that we need to pay attention to. But the question, I guess, for investors is how much of that is already priced into some of the opportunities.
Do you get excited about the productivity gains that are possible with artificial intelligence? Because this is something we've talked about with some investors in the past, that Europe, outside the UK, economies that are less services-based have managed to benefit from automation as a real theme over the last decade or so. And maybe now a services economy gets to benefit from artificial intelligence. That's an optimist's view, perhaps, on a services economy and how it increases productivity. Are you excited by that theme?
Yeah, I am excited, and I think it's a topic that's not something that I'm hugely on top of. But one of the things I've done is immerse myself in some of the commentary from experts. And I have to say that probably without a doubt, the best book that I read last year was a book called The Coming Wave by Mustafa Suleiman. And and this is the creator of DeepMind that was sold to Google. That book goes into both the opportunities and the risks attached to AI. And it's a really great journey across where we have come from, the point we have actually reached, and where we're likely to go next, and attaching the opportunities, risks, threats, to that journey. And I think for anybody, I don't want to promote it too much, but for me, it was a really great educational environment to understand it.
Okay, new year, new book opportunities. Thanks very much, Evie. Thanks for joining us. Evie Hambro, Global Head of Thematic and Sector-Based Investing at BlackRock Fundamental Equities. Coming up on the programme, we focus on Europe's inflation outlook as we look ahead to Germany's CPI print at 1 p.m. London time. We've already had the numbers out from North Rhine-Westphalia. We've had the numbers out from France. We'll get more details of what the European inflation picture looks like so far, how it's likely to develop. That's coming up next. This is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today, 43 minutes into today's trading session, and we're up by 0.5% on the Stock 600. The FTSE up by around 0.4%. The CAC 40 rebounding from some of the losses yesterday, up around 0.3%. We're certainly seeing quite a bit of action in bond markets, and some of that to do with the inflation data that we've already had out here in Europe. It seems to have added to the bull case for European government bonds. Let's talk about that now. Money markets are maintaining their wagers on ECB interest rate cuts as French inflation rose less than forecast in the month of December, and numbers from a bellwether German region show consumer prices falling on a one-month basis. For more on this, let's bring in Bloomberg's Oliver Crook, who's in Berlin. Ollie, good morning. So what's your read of these numbers? Because it gets a little complicated sometimes to take away, to work out what the full picture is, but the markets seem to be trading this as if it doesn't change their bullish government bond narrative.
Completely. And really what's because you're looking at the headline and the year-on-year versus the month-on-month. So when we look at the year-on-year, France coming in at 4.1%. The estimate for Germany is coming in at 3.9%. Those are really quite hot readings for inflation in the Eurozone. And those are really going to be the hottest of the kind of major economies. But when you look into the month-on-month figure, you see a very different picture. In France, month-on-month, it only rose about 0.1%. And when you drill down into all the categories, the only categories that actually gained, the only places that there was inflation were in services and in fresh food. And similarly, in the print that we have out of Germany, actually month on month, we saw a contraction in prices, albeit by only 0.1%. But again, it speaks to the story that kind of on a month-on-month business, this is continuing to move in the right direction. What I think is interesting, though, is the longer-term question, particularly in Germany. Germany is the only one of the big four Eurozone economies that is not expected to reach 2% by 2026. And add to that some of the actions the government needs to take after that budget crisis, which is cutting some subsidies, raising some taxes, inflationary, but of course that is going to weigh on growth. So I really think the acronym to watch out for in Germany is not really CPI for this year, but GDP.
Okay, we'll watch that. Tomorrow we get inflation data for the euro area as a whole. So today we get various countries, don't we? But tomorrow we get the euro area as a whole. So what will all of that add up to for the ECB?
Yeah, so what we're anticipating, according to the markets, is a 3% print for December, which is an increase from what we saw in November, which was 2.4%. And really, that'll be the first time that inflation accelerates in about 8 months because the trend line has just been steadily lower and lower and lower. But listen, there are a couple of things to note within this. That November print was quite a bit weaker than anyone had anticipated. So if the ECB can score a win in November and a bit of a loss in December, maybe not the end of the world. But also looking at core versus headline. We actually are expecting core to continue to diminish in December, headline higher, and really critically, the silver lining here is that that spread between headline and core, which has really been the obsession for the ECB, is going to narrow. And let's also not forget where we came from. We were breaking these numbers, Anna, a year ago, 9.2% inflation in the Eurozone. So again, everything seems to be moving in the right direction. The ECB expects it to continue to happen into 24, albeit a little bit more slowly. So I think for the ECB, what we should be watching for is that last mile, which may be the longest.
Okay, Oliver, thanks very much. Bloomberg's Oliver Crook joining us there from Berlin with analysis of the European inflation story. Let's get to some of our other top stories, well-read stories on the Bloomberg terminal this morning. Bloomberg has learned that TikTok is aiming to grow sales at its US store to as much as $17.5 billion this year. That tenfold expansion of the e-commerce business would set TikTok up as a key competitor to Amazon. TikTok Shop lets users browse items while scrolling through its feed of short videos and live streams. Mark Zuckerberg sold nearly $500 million of Meta shares in the final 2 months of 2023. It came after a 2-year hiatus during which the company's stock price hit its lowest in 7 years. Meta's share price rebounded 194% last year, outperforming every other tech giant except Nvidia. Bloomberg has learned that some of the biggest hedge funds ended the year with double-digit gains in what was a bumpy 2023 for investors. Sources say Ken Griffin's main Citadel Wellington fund posted a 15% return. Izzy Englander's Millennium gained about 10%, according to Pivotal Path. Multi-strategy funds averaged just under 5% growth through November. Let's bring you an exclusive interview now with Morgan Stanley's executive chairman and former CEO, of course, James Gorman. He discussed Bitcoin regulation and the Fed with Bloomberg TV's Sonali Basak.
I've never really understood the value of Bitcoin as a form of stored value. Others have, and others have made a lot of money on it. I joked once, I wish I bought it at $60, and I'm glad I didn't buy it at $60,000. It's clearly speculative. I think it should play for wealthy people a very small role in their financial fabric because it's so speculative, it's so volatile, and again, it's going through enormous regulatory change and industry disruption we've seen with some classic failures of late. So listen, Bitcoin's not going away. It's not a fad. I just don't think it's a core investment. I think it's a speculative asset of which there are plenty of choices.
Speaking of regulation, you've been very vocal about the new regulations being made in the United States about bank capital, about operational risk. Do you believe the rules are likely to change before implementation based on your recent discussions with regulators? And what do you think they will look like at the end?
Oh, they'll definitely change. I mean, they put out an extended comment period, which got extended further. There have been thousands of comments put into the various regulatory bodies led by the Fed. It was a proposal that I would say was extremely aggressive and set a marker. It will not go through in that form. If it did, I think it would have very, very negative consequences for corporate lending across this country, which is not what you want. It's not going to help the economy grow.
Well, you've also spoken about the Treasury market potential impacts from these regulations. We've already seen stresses of late in the Treasury market. Do you have fears that those stresses will be exacerbated?
I can't tell until I see the actual rules, but all I know is what was put out is highly, highly, highly unlikely to be what is ultimately regulated. Now, investors don't necessarily see that or agree with it, but in my experience, I've been doing this a long time. I was on the Fed board for 6 years in New York. I chaired the FAC in Washington. I think this is a highly aggressive proposal that will be materially wound back when it finally becomes law or regulation.
Morgan Stanley's executive chairman and former CEO James Gorman speaking with Bloomberg's Sonali Basak. Now, coming up on the program, traders await more European inflation data due today as markets weigh when the ECB's first rate cut will come. We heard a little about that from Oliver Crook over in Berlin, digesting the German data so far and the French data that we've had already. Eurozone data due tomorrow. We'll discuss how the market is approaching this data set. That's coming up. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make this decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today at 53 minutes into our European trading day on this 4th of January. European equity markets are trading a little higher this morning, up by around 0.4%, 0.5%, shall we call it, on the Stock 600. The CAC 40 trying to bounce back from some of the losses of yesterday. US futures also a little positive, up by just 0.1%, though, so not by much. Let's talk about what's happening in the markets. Noor Al-Ali joins us from the Markets Live team to give us her insights. Noor, good morning to you. And we'll pick up with you where we left off our conversation with my colleague Oliver Crook around the European CPI prints, because we're building up this picture gradually. He was talking about, the complexities in some of the data out of North Rhine-Westphalia and out of France. Excuse me. But on both cases, it seems to be the month-on-month number giving some comfort to those who believe that the European government bond rally continues. And that's what we're seeing this morning.
Yeah, so the disinflation trend is intact in Europe, which is very pleasing, particularly for European Central Bank policy members who, have been calling for this trend to kind of come into play. So that the fact that it's happening and that it's seen and there's sort of a consensus that we will see prices continuing to moderate is great. But also, on the other hand, you are seeing market pricings of an ECB rate cut as soon as March. A little bit too optimistic, I'd say. If you look at services inflation in France picking up, core inflation is still quite high. Bloomberg Economic also expects the headline euro area inflation to likely pick up in December as well. So I think that will potentially, split the markets here into thinking potentially the ECB can stay on hold, at least until we start seeing those core numbers start to ease as they'd like to see them.
It's a complex one, isn't it? Because the disinflationary sentiment or vibe, or is already very entrained and very strong, isn't it, for the European, for the eurozone? And a lot of the data has been and remains pretty weak in terms of the fundamentals of the economy. So you wonder where that leaves the ECB. But there is so much expectation of rate cuts.
Yeah, absolutely. And that's where you would think, staying hold, staying the line until we start seeing, that transmission of monetary policy feed through is, I think, what the ECB has been calling for quite some time, and also what the markets seem to come to terms with, at least to an extent, right? So I would expect that, I do see that European bonds will stay supported. I don't see further gains as well because, they have rallied. If you look at the front end of the German, bond curve, you'll see that they've rallied quite a bit in the fourth quarter. So I do see that, a lot more, hopefully less volatility, as we start seeing those core figures come down.
Where we have seen volatility is oil prices. We saw a big drop, actually, just a couple of days ago in oil prices, and then a big climb again. We're now up at a 79 handle once more on Brent, up another more than 1%. Geopolitics meets weak demand expectations.
Yeah, absolutely. I started the day yesterday looking at oil and thinking, why aren't they rallying? There's a lot of factors in the market short term, particularly on the geopolitical front in the Middle East, which is in large a big, a lot of countries are massive producers of oil, the largest in the world, but oil isn't really responding. And that's mostly because it's a supply story on the short end, demand story on the long run. And so, towards the afternoon, prices were rallying and they've rebounded, mostly because we've had news out of Libya, its top oil field being shut because of protests. Yes. What's happening in Iran right now and across the Red Sea. Okay. A lot of this is concerns about supply and what that means for OPEC Plus.
We'll certainly watch all of those geopolitical developments. Noor, thank you very much. Noor Al-Ali from the Markets Live team. That's it for this hour of programming. More on the markets to come. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London in for Francine Lacqua. Here's what's coming up on today's program. Investors bidding for both stocks and bonds on both sides of the Atlantic. December's FOMC minutes put the spotlight on the pace of QT. Meanwhile, supply disruptions in Libya and rising tensions in the Middle East pushing oil just a bit higher. Blast in Iran killing nearly 100 people, adding to the geopolitical turmoil. Plus, European inflation in focus, consumer prices rising in France, those moving higher as well. German CPI likely to have done the same in December. We're going to bring you the data live in just a few minutes and get you that instant analysis. But before we do, a quick check on those European markets map, because again, remember, it is still very light trading volume. So when you're talking about what is actually moving right now, it's a little bit of everything. But again, the margins really matter. You are seeing green on the screen, but I would call it a margin of kind of autopilot, essentially, when you talk about the European trade. Again, it is still only the first week back. Remember, the last few trading sessions have been broadly negative on both sides of the Atlantic. So perhaps just a little bit of rebalancing there, retracing, I should say, is a better word, as we go into whatever next week brings. In the meantime, we're getting some more breaking regional inflation data coming out of Germany. I want to get that instant analysis. Bloomberg's Oliver Crook standing by in Berlin. Ollie, walk us through the numbers.
Yeah, so what we're getting is sort of a follow-on from what we saw from North Rhine-Westphalia earlier this morning, which is a year-on-year figure that is quite a bit higher than it was last month. So we're coming in at about 3.5% in Hesse, 3.4% in Bavaria, 3.8% in Baden-Württemberg, and you take that with a 3.5 from North Rhine-Westphalia, that is going to be quite a bit hotter. However, when you go at the month-on-month figure, you're getting some contraction in some areas, you're getting some zeros, and you're getting some 0.1%. So overall, this doesn't sort of dislodge the direction of travel for inflation over in Germany. And you go and you see a similar story over in France, where we got the headline number of 4.1%. That is a very hot spot for the French economy. But again, you go month on month, it only gained by 0.1%. And when you drill down into those French numbers, there were in fact only two categories where prices rose. That was in services and fresh food. And it's again a holiday month, so perhaps not a total shock. I think what's interesting, though, is the question in Germany is longer term. It is the only of the four major economies in Europe that is not expected to hit that 2% target by 2026, so still quite a way out there. And really, on top of all of that, all of the headwinds in the German economy, we're expecting a technical recession at the end of last year. I think GDP, actually, in Germany is going to be more important than CPI.
Talk to us about the translation of what this means for the ECB here. Does this change their strategy? You mentioned that we had on the month-over-month number 0.1%, but if you compare that to the last couple of months, you did have negative numbers in the last couple of months. Should the ECB be worried at any point?
It's true. I think that broadly speaking, however, the narrative stays more or less intact in terms of prices coming gradually into line with that 2% target from the ECB. What we're expecting for December is 3%. Yes, that is higher than 2.4%. Yes, it is actually the first acceleration in inflation in about 8 months in Europe because the trend line has been solidly downward. However, we got to keep a couple of things in mind. For one thing, that November print was very weak. It was 2.4%. It was much weaker than most people had anticipated. So maybe the ECB scores a bit of a loss in December that offsets the gain over in November. The other thing we need to keep in track of is that we're considering actually core is going to go down just a little bit, and core is what has been the real driver here. So that spread between core and headline is going to come a little bit closer aligned, is going to narrow a little bit, which is really what the ECB is looking for. And again, Creedy, let's not forget, what we were looking at last year when we were breaking these numbers was 9.2% inflation in the Eurozone. So really, we've come a very long way. I think the issue is going to be that last mile for the ECB. Getting to 2% might be the longest.
Certainly something we're going to keep an eye on as we talk about whether or not Europe and the European central banks can actually catch up with what you're seeing in the rest of the world. Bloomberg's Oliver Crook there breaking down those numbers. I want to get a little bit more analysis, though, build on what Ollie was talking about. Eric Nelson joins me this morning. He's a macro strategist over at Wells Fargo. Eric, we just got that data that Ollie just broke. We're talking a little bit about the translation or the read-through into the ECB as well. But at a time when European economies are clearly struggling by a bigger margin than their other G10 counterparts, does that mean we're going to start to see a bigger divergence between the Fed and the ECB?
Well, not necessarily, Critty. And I think the big difference here is the ECB has a single inflation mandate, whereas the Fed has a dual inflation and labor market mandate. And the ECB historically has been known to, let's say, take a little bit longer to ease, or in many cases even tighten late in the cycle. I think this time around will be relatively similar in the sense that the ECB will be slower to cut than many think. Now, we think the Fed will start cutting around, say, May, June. I think the ECB will be on a relatively similar timeline, relatively speaking.
But you said slower to cut. Where is that coming from, though? What's driving that? Is that a question more of that inflation still is going to be a problem that sticks around, or that there is some element of European resilience? Why that call?
It's more about inflation, I think, is really the key. And inflation's a lagging indicator, right? And so are wages. The ECB has talked about wage growth as being a concern, those second-round effects. You can debate all day whether or not these affect inflation and whether or not they're real, but the ECB is clearly worried about them. And I think until the Fed makes a clear, decisive turn toward cuts in terms of actually delivering them, not just talking about them, I think the ECB will be hesitant to be the first mover on the rate side when we go lower.
So before the holidays, you were right here on set with me. We talked a little bit about your euro-dollar forecast. Let's revisit that. 2024, your euro-dollar call.
Yeah, so in the near term, we do think that it continued to drift higher a little bit in the sense that Fed's moving toward cuts. Yes, the European economy is certainly weak, but some of that's already incorporated. And I think as we get in the middle of the year, though, we'll start to see that fade a little bit. We do think euro-dollar drifts back down towards, say, 105, 107 on global economic weakness. We have a recession forecast for pretty much all the major economies. That tends to be very dollar positive historically.
So this is, at its core, though, a dollar story as opposed to a euro story.
That's right.
But what does that then mean in terms of the data that we're actually looking at? You talked about the emphasis on inflation, and to your point, the ECB doesn't have that dual mandate of full employment that the U.S. has. But I'm curious about whether the labor market is still relevant at a time when, to your point, wages are still driving the inflation narrative.
Absolutely. I think that the big difference with the Eurozone labor market is it tends to be more inflexible and slower to react than the U.S. labor market, right? You look at German unemployment during 2008, 2009, for example, barely moved. It's more or less a blip on the radar, whereas you saw, a 4 or 5 percentage point move in U.S. unemployment. So I think it's hard for the ECB to even, in theory, have a labor market mandate when it moves so slowly and tends to lag so much relative to the U.S. labor market.
I'm curious about what you think in terms of the liquidity story. We've been talking a lot about it this morning in particular, post the FOMC minutes, suddenly a renewed focus on things like quantitative tightening, for example. But I'm curious if that means that you are going to start to see liquidity issues actually show up to a greater extent, not just in the United States, but right here in Europe.
Well, I think there's a couple of things that strike me on the liquidity story. One would be people view the liquidity story and what the Fed's doing on QT as sort of a second signal on interest rates, right? To the extent that the fact the Fed is talking about dialing back QT, it's not a coincidence. They're also talking about rate cuts, right? So these things go hand in hand. I think the other thing that stands out is, the Fed being preemptive and potentially ending QT before there's an issue. That's a change, right? Usually they kind of just push and push and push, wait for something to break, and then they'll react. But I think this potential shift toward more preemptive, proactive change, that would be, I think, very dollar negative and I think push rates lower overall.
When you talk about pushing rates lower overall, though, there is still that question of how much supply can actually be digested in this market. Some might say, well, if the Fed is going to pull back on their balance sheet a little bit, or at least on the quantitative tightening process, and ease that, it's going to kind of crunch the supply you see in the market, which could even incentivize the Treasury to perhaps raise even more. Is that something that would be welcomed by market makers?
I think so much really depends on the economic backdrop. I think you saw this Treasury supply narrative really only become a narrative as rates were rising really aggressively. Suddenly people looked and said, why are rates up? Well, maybe it was the supply. I think maybe it was a little bit of a red herring or something that was overplayed to some great extent, especially as most of the issuance was really in the bills in the short term. Yes, there's a lot of issuance to digest over the next couple of years. That can put something of a floor under rates. But if the U.S. is headed for a recession, the supply narrative becomes much less relevant.
But then what drives that U.S. recession narrative? Where does it come from? And I put this in the context of some commentary actually from our Bloomberg economics staff. Anna Wong, she's our chief U.S. economist. She made the point that historically rate cuts have come far before the labor market has demanded it. So if you're talking about rate cuts in 2024, I think 5 are priced into the market right now. Are we talking about them as an insurance cut, which is what Jay Powell did under the Trump administration back in 2019? Or are we talking about it as more of a necessity to keep the economy alive?
Well, they almost always tend to start as insurance cuts, right? Even in 2007, the Fed was cutting well before there were real significant economic ructions. There were some financial ructions.
Yeah.
We're not really seeing that right now. I'd say the labor market is definitely weakening. It's not falling off a cliff. I think it warrants rate cuts. But for right now, these are insurance cuts. The Fed knows they can't wait for the recession to take hold. They have to get ahead of that. At some point, it could become more of, okay, we're panicked. We're trying to catch up, but we're not necessarily there yet. For now, these are preemptive.
How much power do they actually have right now, though? And I'm putting this in the context, again, of the fact that there's so much money parked in on the front end of the curve. There is a line of logic out there that basically says the markets are more directly in charge of the economy than the Federal Reserve is. And that is a scary thought when you talk about the bond volatility we've seen in the last 12 months. We're talking about rate cuts that are priced in. Should they be either insurance cuts or one that serve more dramatic deceleration in the data? Are the markets more in control here?
I think the markets are just reacting to the Fed, ultimately. The Fed is the one setting rate policy, right? And yes, the markets are probably a little bit ahead of themselves on where Fed cuts are priced. But to be fair, the Fed has clearly leaned into cuts. And just look at the December dot plot, the December communications. They've maybe tried to lean against it a little bit recently with maybe the minutes and some follow-on commentary. But read through the noise here. They're going to cut rates, right? And so I don't think the market's necessarily more in control in the sense that the Fed's the one setting policy and the one communicating they're going to cut rates, and that's what's really driving things here.
Well, they're setting, sure, the Fed funds rate they're setting, but the actual mechanism that influences the economy, I mean, you're no stranger to this. When you're talking about even break-evens pricing, that has a very real impact on inflation in the real economy. It affects, the average American's pocket, basically. So I'm curious then, if the market is front-running the Fed, as you've suggested, does a lag even matter in the conversation of whether or not there is one?
Yeah, I mean, I think that what strikes me about the narrative is that I think it puts a little bit too much emphasis on what we call financial conditions, which tend to mostly just reflect stock prices. And then in terms of how quickly these short-term rate moves feed into economic decisions, we talk to a lot of business leaders, CEOs. Sure, some are looking at the day-to-day movements of the 2-year and the 10-year Treasury yield. Most are just looking at things over a longer time frame. They're not looking at week in, week out, what's the 2-year doing. So I think it does tend to have more of a lagged impact and more of a broad impact spread out over time than I think people give credit for on Wall Street.
You might get some pushback on the stock market influence financial conditions.
Sure, I will.
They'll get cringed a little bit the minute you said it. Anyways, Eric Nelson, we have to leave it there. He's a macro strategist over at Wells Fargo, walking us through just how much power the Federal Reserve has in this environment. We thank him, as always, for joining. But a big part of that conversation is going to be what happens in the geopolitical landscape. Remember, you have U.S. elections, but you also have a lot of rising tensions in the Middle East that could impact not only the inflationary narrative, but how the Fed even navigates it. Of course, that's where we're going to go next. Blasts in Iran killing nearly 100 people. We're going to dive into the details next. Stick with us. This is Bloomberg.
think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish trend has left the station.
This is what Powell does not want to see. This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
Blasts in central Iran have killed nearly 100 people, adding to risks between the war in Israel and Hamas. It's widening now potentially into a broader regional conflict. It all comes as more than a dozen countries warn that Iran-backed Houthis against further attacks in the Red Sea. I want to get a little bit more context on this developing story. Roz Matheson, our EMEA news director, is all over it. Roz, this happened around the grave of the former general commander of the Iranian Revolutionary Guard, which, from an American perspective, was something that President Trump has been very vocal about as a point of pride in having when it comes to his foreign policy and the way he's tackled Iran. It's a really sensitive issue around the world, that the location of these attacks in particular. What more do we know about it?
Well, there's not much we do know because we're relying on Iran for a lot of the information. What we do know is that these blasts killed about 100 people, injured several hundred others. We don't know who was gathered at that site. Of course, it was to mark the 4-year anniversary, as you said, of the death of General Soleimani in a drone strike by the US. So there could have been quite high-level Iranian officials there. We just don't know who was actually killed so far in that attack. And Iran is actually sort of criticizing Israel for it, but not overtly blaming Israel or the US for this attack. That's something that they're yet to do, and they may not even choose to do so. But it's very embarrassing for Iran in a way that this attack happened. So it will mean they have to retaliate in some sort of way. And is that directly against Israel? Is it more via their proxies? Of course, they've got many of those in the region. Is it via Hezbollah? Is it via the Houthis? Do they do something in Iraq? But they're going to have to feel the need to respond in some fashion to this. At the same time, even Iran seems to be aware of this risk of broader escalation and not necessarily wanting that to happen. And so we'll probably see some sort of calibrated response that's not directly targeted at Israel or the US.
It's interesting that we talk about this as well, because we know the Iran had also sent warships to the Red Sea as well. So even though it does originally seem like perhaps they might use their proxies, perhaps even getting directly involved is on the table. As we're speaking, though, Roz, we are getting some breaking headlines here coming from CCTV. President Xi telling Iran that China is condemning the terrorist attacks and saying that China, quote, firmly supports Iran in safeguarding their security. Those are some pretty strong comments from China. Talk to us a little bit about perhaps the precedent and the support that Iran has around the world right now.
Well, it's interesting because China, of course, has been a supporter of Iran over the years and certainly quite interested in its own development in the region, and that's really about countering the US and its influence in the Middle East. So anything that plays to its advantage, of course, it's going to comment on. But for China, it's also this existential thing about it says its agenda is not to interfere in other countries' affairs, and it sort of comes in when other countries do so. And so that criticism for the attack is not that surprising from China, and to use that moment as a wedge again against the West, because you've got this grouping of China, Russia, Iran, other countries in the Middle East, sort of pulling them further away from the orbit of the US and using Iran in that fashion. And we've seen Iran, of course, in turn, sort of implicitly supporting Russia for its invasion of Ukraine. So it's a group of nations that all have the same interest, which is to sort of develop an alternate power base to the US. And so China's comments there about Iran aren't surprising. China does not want to get directly involved, though, at the moment in the events in the Middle East.
Yeah, it's a really dire situation, and we just covered the Iran story, but of course there's always the Red Sea component as well. You talked about the Houthi rebels, and I think there was some estimate or some consensus that by this point, a couple of weeks and now months into the conflict, we would see tensions ease in the Red Sea, and we've seen the exact opposite happen, to your point. Roz Matheson, we have to leave the conversation there, but we thank you so much for your reporting this morning. Plenty more to come. Stick with us. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to The Pulse. I'm Kriti Gupta, filling in for Francine Lockwell, Morgan Stanley's executive chairman and former CEO. Among those expecting the Fed to cut rates this year, we spoke exclusively with James Gorman on his way out. Take a listen.
First half of the year, I suspect nothing. Back half of the year, they could easily move they could move a couple of times. We started this journey with inflation at 10%, rates at 0, unemployment at 3.5%. And my objective was to get us to 4, 4, and 4. 4% inflation, 4% rates, 4% unemployment. We're about 3% inflation, we're 5%, 5.5% in rates, and we're about 3.5% in unemployment. So rates will come down.
Morgan Stanley's executive chairman and former CEO James Gorman there speaking to our Wall Street correspondent Shonali Bassick. In the meantime, sticking with the financial space, Bloomberg has learned that crypto asset manager Grayscale Investments is in talks with firms including JP Morgan and Goldman Sachs for them to potentially play a key role in its proposed Bitcoin ETF. The bank's being considered to be, quote, authorized participants, basically meaning that firms have the power to create and redeem shares of the fund itself. This all comes as Grayscale looks to convert its Bitcoin trust into an ETF. Bloomberg has also learned that some of the biggest hedge funds ended the year with double-digit gains in what was a pretty challenging year of 2023 for investors. Sources saying that Ken Griffin's main Citadel Wellington fund posted a 15% return. Izzy Englander's Millennium gained about 10%, and multi-strategy funds averaged just under 5% growth through November. All that data coming from Pivotal Path. Now over to the tech space. TikTok is aiming to grow the size of its U.S. store to as much as $17.5 billion this year, all according to people familiar with the matter. It's an expansion of the social media's e-commerce business, which would put them as in direct competition to Amazon. Now, TikTok Shop, which melds online entertainment with impulse buying, lets users browse items while scrolling through its feed of short videos and live streams within its main app. I want to stick with the corporate space here and talk about two major stories to put on your radar here, starting with Next. They've raised their profit forecast for the 5th time since June, saying it's going to grow even more next year after the British home and clothing retailer thrived during the Christmas shopping season. So those shares higher by about 5%. But on the downside, you've got JD Sports slashing its profit forecast, blaming unseasonable weather and cautious consumer spending for pretty weak sales during the crucial holiday period. You can see those shares taking a massive hit down about 21% in the European trading day. Coming up, a special focus on UK politics and what's widely expected to be an election year. We're going to unpack the biggest challenges for the Prime Minister. Stick with us. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Good morning and welcome to Bloomberg UK. A special focus on the biggest challenges facing the British government, economy, financial services, and of course the markets. I'm Kriti Gupta in London. Just going to start in the political space. UK Prime Minister Rishi Sunak and his ruling Conservative Party could face a reckoning with voters this year. Britain now expected to head to the polls in 2024 with an election most likely in either the spring or the autumn. But before then, Sunak has some work to do. Opinion polls show that the Labour Party maintains a wide lead over the Tories, and the Prime Minister's popularity among voters in his own party at a record low. Well, top of mind for the public is the cost of living. Despite inflation dropping way faster than economists expected, it's putting way more pressure on Sunak when it comes to things like tax cuts, immigration, and even health care. And now the Prime Minister has began 2023 asking voters to judge him by 5 pledges, but a year later, he can only claim victory on one of them. It leaves him in an uphill battle to fight before the election, and with a preview of the year ahead in British politics, as well as the economic data out later today. UK correspondent Lizzie Burden is all over that story. She joins me right here on set. Let's start with some comments here coming from Labour leader Keir Starmer.
Yes, he's going to be speaking later today in Bristol. He's expected to present himself as the change candidate, saying that Britain's crying out for change after 14 years almost of national decline. He's going to say it's time for national renewal under Labour. But we're also going to hear from Rishi Sunak, and he too will present himself as the change candidate after Boris Johnson and Liz Truss. But it's a difficult position for him. As you say, Sunak's Conservative Party is behind over 20 points in the polls, and his party's divided after all this time in power. But in the Labour camp, you've got strategists warning their own members, don't be complacent. They point to Donald Trump's 2016 victory, where actually the result defied the polls running up to it. And so this is a glimmer of hope for Rishi Sunak. He's going to himself try to defy the polls, and an opportunity for that will be the budget. So we've got an early budget on March the 6th. It's set tongues wagging in Westminster whether we're actually going to have an early election in May. And what the Chancellor, we expect, will try to do is lay a load of traps for Labour in terms of tax cuts, making tax cuts that Labour would struggle to reverse, but then would struggle to keep up with their own fiscal commitments in addition. And then the question becomes for our audience, will the bond market have faith in Labour's spending plans?
There's so many things to dive into there. And Lizzie, we know that we are going to be able to count on you for all of it. But for now, we have to leave it there. Lizzie Burden there, our UK correspondent, walking us through some of the key parts of kind of what Sunak has on his plate. But of course, as the prospect of a general election nears, as Lizzie just pointed out, the economic policies of both Labour and the Conservatives coming into focus for the voters. I want to get a little bit more analysis, build on what Lizzie Burden had to say with Lizzie Galbraith, political economist over at Aberdeen. Lizzie, a pleasure to have you on the program. Thank you for joining us this morning. Build a little bit on what the other Lizzie just had to talk about, just how much work Sunak actually has cut out for him, and how much the timing of an election may work either for or against him.
So Sunak does have an awful lot of work to do. We haven't really seen him make any headway in the Conservatives' polling deficit over the last year since he became leader of the Conservative Party. And that's a real challenge. It was always going to be difficult to come back from a 20-point polling deficit in 2 years. it's even more challenging to try and do it in one. And we've seen the Conservatives try multiple different resets, lots of different approaches, and nothing's really persuaded the public to look again at the Conservatives after some rocky few years in government. So I expect Sunak to try and use the budget coming up in March as the next springboard moment for the Conservatives. I expect him to try and focus that budget on some public-friendly sort of retail policies, possibly including some more tax cuts to try and cut through with the public, and to try and get some gaps between Conservative policy and Labour policy. But nonetheless, it is going to be extremely challenging. And on the timing of that election, one of the big questions is, yes, may make a lot of sense to some strategists in the Conservative Party. It allows you to go earlier, to make sure that you know the ground you're working with. But equally, that would only give them 6 months to turn things around, and that is a very, very tall order. We do know that, generally speaking, the polls tend to narrow in favour of the incumbent government ahead of elections in the UK, but a 20-point narrowing is a really, really big ask, and I think Sunak does face a huge, huge battle to gain the support that he would need to stay in power by the end of this year.
Lizzie, we're talking a lot about tax cuts. We're talking about them being in the spring budget. Can we just get down to the numbers here? Can the UK government even afford tax cuts right now?
It's a really tricky question, because actually what we saw at the autumn statement was the government use some frankly unsustainable future public spending cuts to finance the tax cuts it announced then. So I think one of the things that we're going to be looking at quite closely is just how credible this strategy can be for the Conservatives going forward. We're already seeing quite a lot of scrutiny of whether Labour's spending plans are credible. I think that actually the same question can be asked of the Conservatives as well, because if you're penciling in these really quite steep public spending cuts at the tail end of your fiscal horizon to finance tax cuts now, I would question whether or not that's feasible. And if we see the Conservatives return to that strategy in the spring, depending on what the fiscal outlook looks like then I think that could be questioned more vocally this time around if they become sort of repeat users of that strategy going forwards.
So a lot depends on the fiscal outlook, but a lot depends on the monetary outlook as well. Rishi Sunak very famously, when asked about why the Conservatives aren't actually delivering on the tax cuts that have been such a legacy of their party, saying that, well, inflation is a tax, and therefore inflation is the #1 priority. Talk to us a little bit about now the fact that rate cuts are actually getting priced into the market. Does that just add even more pressure for Sunak to deliver?
I think it probably will certainly add to the clamour on the Conservative backbenches. There's many people in the Conservative Party that have been calling for tax cuts now for some time, and any improvements in the economic position of the UK will lead to those calls intensifying. One of the things to note, though, is that although Conservative MPs generally do want tax cuts, they don't necessarily agree on what those tax cuts should look like or what taxes to focus on. Some Conservative MPs are very keen to see inheritance tax cut, for example. Others would like the government to focus more on income tax. So there is differences of opinion within the Conservative Party on that. But we think that we're not actually going to see any rate cuts in the UK until June, which would put it past the spring budget. It may well be one of the factors that leads the government to hold on until the autumn to actually hold that general election and be able to point to rate cuts as a measurable sign that the economy is turning a corner and that they've led an improvement in the public finances.
By comparison, though, is the Labour Party offering anything better? We know that some of the green policies, for example, have been kind of a pillar of some of what they have to bring to the table. But again, the affordability question kind of rears its ugly head again. And we know that even Rishi Sunak has pulled back on some of that green spending as well. Can Labour keep up?
This is the big question. We've had some quite eye-catching policies from Labour. We've got some very ambitious plans for a very different style of government. under Keir Starmer, but they haven't really yet been able to fill in the blanks about how they would actually afford this. They've swerved a lot of questions about what taxation would look like. They're swerving questions about what their fiscal rules would look like. And that is going to be something that Labour are going to have to work on really hard this year. We know that a lot of their policies are individually quite attractive to the public, but there remain a lot of concerns about whether they're actually able to implement them in practice. And I think that is going to be the big question for Labour. Can they maintain this poll lead that they've built up over the past 2 years, while actually explaining how they're going to fund these measures? Can these policies remain credible to both the public and to markets once they are scrutinised, once the costing of these policies is scrutinised going forwards? And we're likely to see the Conservatives really try and ramp home the scale of what Labour's pledging as well, present it as a risk to any economic recovery that we see by the time the election is held.
What kind of progress might we see on the cost of living crisis seems to be the central question for 2024. Lizzie Galbraith, we have to leave it there. She's, of course, the political economist over at Aberdeen. We thank you so much for insight and analysis this morning. Plenty more on some of the big election issues coming up on the program. Stick with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Rishi Sunak's battle to return to number 10 will depend on public opinion over key issues like immigration, the economy, and even healthcare. From Supreme Court rulings to doctor strike, the past few months have been quite the challenge for the Prime Minister. Joining me now, our Westminster watcher, UK correspondent, our political team expert, whatever you want to call his title. Joe Mays is all over this story. Joe, talk to us about his success, perhaps, when it comes to Rishi Sunak.
Well, it's been tricky on those big 5 pledges, which include things like cutting waiting lists in the NHS, reducing small boats crossings, growing the economy, cutting debt. On pretty much all of these issues, it's been very tough. NHS waiting lists, larger than when he took control as Prime Minister. We have debt has not fallen. The economy has barely grown. Yes, small boats crossings have come down a bit, but he hasn't stopped them. He can score success on the goal of halving inflation, but that's kind of 4 out of 5 where he hasn't really succeeded. So it's looking pretty tough in terms of will voters take a step back and say you have succeeded as Prime Minister. I think that's tricky for him.
How much of a role does timing play here? We're talking about a general election, either in the spring or the fall. Does the extra time, is that a benefit for Rishi Sunak, or does that work against him?
I mean, that's the big question in Westminster. How do you make that calculation? My sense is that he will probably want to continue in office for really as long as he can and hope that the economy improves perhaps, and hope that in the minds of voters he can perhaps deliver some more tax cuts in, say, a spring budget, allow those to take hold, make people feel the benefit of that, hope that the cost of living crisis eases, and then push that election more into the autumn. But, that is the big question. How do you make that calculation?
But what does that mean for Sunak? Like, what's on his to-do list there to win over the public?
I think it's just having more time in number 10 to just deliver the policies and the promises that he's set out, such as on small boats, such as on improving the state of the NHS. Just give yourself more time in office to make progress on those issues. That might be how he sees it. But there are risks to that. For example, if you go for an election in the autumn, you then have a summer where there might be more small boats crossings, which would hurt your ability to claim success on that pledge. So it's a really tricky balancing act, and he's got some big decisions to make when it comes to that election timing.
In terms of the competition, what he's up against here feels like every time there's a kind of knock against Rishi Sunak, it's a win for the Labour Party. Obviously, it's an enemy political system, but are the Labour Party's policies competitive at all here?
Well, we're still at a stage where Labour hasn't really set out in great detail what their policy platform is. It's still somewhat vague. We have some pledges, such as spending £28 billion a year on the net zero transition over the course of the next Parliament. We have things like scrapping the non-dom tax status. There's some headline pledges, but the depth of the policy platform isn't there. And we'll be looking for that in these next few months, and voters will have to take a look at that. So, yeah, it's kind of a watch and see, really, when it comes to Labour's policy positions.
Yeah, certainly a lot to digest there. Bloomberg's Joe May is all over it. Our Westminster Watcher. I love that alliteration. He's going to be adding that to his business cards anytime soon. We thank you so much for your analysis this morning. Coming up, what does it mean for the markets, for the investability of the UK broadly? Plus, London's FTSE 100 turning 40 this week. It sounds like a celebration. It sounds like something to be excited about. Is it really? We're going to dive into it. Stick with us. This is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
London's FTSE 100 turns 40 this week, but some might argue there isn't that much to celebrate as the index trailed its counterparts in recent years. Celebrating or maybe even cringing is Bloomberg senior markets editor and opinion columnist John Authers. He joins me right here on set. John, you wrote a column this week about that kind of underperformance. Even though the FTSE 100 is one of the most investable in terms of access indexes in the world, why is it falling behind?
Well, there's a number of reasons. Obviously, some of this is to do with the UK economy. Some of this is to do with the lack of big tech companies. You know, if there were a British Google or Amazon, presumably it wouldn't be lagging anything like as much. There is certainly a strong argument to be made that British pension funds, which have been encouraged to there was a great concern about 20 years ago about the possibility of a pension crisis, making sure that they were able to meet their guarantees to their pensions, but what that involved was selling stocks and buying bonds, with the result that we're now, much more underinvested as a nation than most other leading countries. So there's lots of reasons behind it, but there's no real way of obscuring the fact that this is disappointing. London was absolutely an equivalent to New York for many years, and in the last 15 or so, the way the stock markets have diverged is, pretty soul-crushing if you're British.
Yeah, and you're already even seeing that add to some of the damage that even in just the last year you saw in terms of the IPO market and the deal market. The flows aren't coming to London. I love that you said that there's no Apple or Microsoft equivalent in the UK. As you were speaking, we look up the top 5 members of the FTSE 100. Out of the top, Shell, AstraZeneca, HSBC, Unilever, and BP. Those are 5 very different companies.
It doesn't sound so unlike the Dow Industrials for much of its history. It's just it needs a couple of tech companies in there because that's where all the growth is these days, and there are none, which is a little sad.
But couldn't you argue, one of the criticisms of some of the other indices around the world is that it's not diversified enough, that breadth is a real issue. Isn't the FTSE 100 serving that on a platter?
You could, yes. You can make that argument. You don't have the really massive overconcentration that you have in the S&P 500 these days, thanks to the Magnificent Seven.
Or the Stock 600 with luxury.
But you do also need to bear in mind London's greatest claim to eminence these days is that it's still the venue of choice for big commodity companies. So there's a large number of mining companies that are quoted here that really have a head office here and all their operations are somewhere else. And so you could argue that we are overexposed towards the materials sector here. That is part of the underperformance of the last 15 years is that it's been a bear market for commodities, and that's bad for companies like Rio Tinto and Glencore who are quoted here.
I want to continue that tour of assets because as we talk about, of course, the stock market and the exposure you want to the commodity space through some of these kind of British adjacent stocks, or at least stocks that are listed here in the UK, we should talk about the exposure to commodities through the currency space as well. Because, of course, London known as the hub for commodities, but also foreign exchange for the same level. Is there a read-through between the cyclicality of the commodity space and the cyclicality of the pound? And don't make me repeat the fact that some would call the pound an EM currency or acting like an EM currency. But is there some kernel of truth to that?
Yes, there is some kernel of truth to that. At the moment, we have a thoroughly dollar-oriented system, so a lot of it is dependent on if the dollar has an inverse relationship with commodity prices in many cases because commodities are denominated in dollars. Therefore, when the dollar is getting weaker against commodities, the pound will generally get stronger. And I mean, that is a way in which, not getting back into the entire Brexit debate, but there is a sense in which there is a loss of sovereignty for more or less everybody other than the states, because so many critical decisions about the currency are sort of dependent on big global markets rather than on any decisions you can make here.
Yeah.
I mean, in general, I think because we have seen such an aggressive pivot in the States, that means you get a yield pickup with gilts compared to treasuries, and it means that the pound at the moment, when you think it nearly broke parity, 15 months ago, looks oddly strong. If it's a very popular call that the dollar is going to be weak this year, it's also a very popular call that the Bank of England is going to cut many times this year, faster even than the Fed, which I find
ironic, isn't it? Because Andrew Bailey was supposed to be the last hawk standing, and now perhaps the first to crumble. What do you think?
I think that I think the excitement about imminent rate cuts is overdone back in the US. I think it's overdone here. There's a very good reason why they might be more likely to cut here, which is that the economy is in worse shape.
Yeah.
If you're going to have a recession, that strengthens the case for cuts quite considerably.
Yeah.
That said, I did just check. Core inflation has come down very fast and much faster than expected. It's still over 5% in the UK. And the Bank of England has a single mandate on inflation. I don't see how you can cut as aggressively as people think they're going to unless core inflation really keeps careening down. So I'm personally nervous about whether that degree of help from interest rates is going to arrive.
John, I'm going to put you on the spot. 30 seconds here.
Yeah.
We have a potential general election coming up this year. Tax cuts on the agenda. Will a potential tax cut from the Tories change the market view of the UK? 30 seconds.
No. Well, if you want me to take a few more seconds than that, we learned from the Liz Truss gilts crisis that the markets don't think that this country has any fiscal space. Part of the reason they're so calm about Labour is they think they won't be able to spend anything. And part of the reason they're so calm about the Tories is they don't think they'll be able to cut tax. I don't think it would make a difference.
Well, the market's voting quite literally with their dollars, and in this case, their pounds, and saying that, well, Rishi Sunak and his counterparts maybe can't deliver. That is the take from John Authers, our Bloomberg senior editor for markets and opinion columnist right here. We thank you so much for joining us today. That does it for the Bloomberg UK show. Bloomberg Brief is next. Danny Berger in London, Manus Cranny in New York, setting you up for the U.S. trading day. Everything you need to know going into the end of the week. Stick with us. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Investors pare back the rate cut bets with the Fed minutes showing policy will remain restrictive for some time. Treasury steady after a two-day sell-off. Mounting tensions in the Middle East. Twin explosions in Iran kill almost 100 people in the city of Kerman. No group has claimed responsibility for the blasts. Over in China, 10-year bond yields dropped to their lowest level since 2020 amid rate cut bets. Onshore yuan falls for a third day. A very good morning. You were overly enthusiastic in what dialing back really meant from Jay Powell. The bond market has raised its questions about the veracity and the timing of rate cuts. Now you must debate whether the rate cuts in the United States will be backloaded rather than front-loaded. You just see this turn a little bit higher in yields. There's a gravitational pull to that 4% market, 4% mark. What you can say is this, is the swaps market has decided to write down the near-term cuts. You're looking at March, that sort of furious roaring full 25 basis point cut in March has dissipated ever so slightly. The short end of the curve, you just seen yields tick down ever so slightly. Crude is bid by 1.25% this morning. Again, we put on 3% yesterday. There's a confluence of events here. Protests in Libya take out 365,000 barrels a day. So you have their production curtailed. You've got Houthi rebels again attacking in the Red Sea. And of course, we have this Iran blast. There's blast in Iran. Who executed that? And the death toll amounts. We'll talk about that on the geopolitical stage in a moment. You're looking at the dollar rising against the yen. Will the Bank of Japan delay ripping off the Band-Aid of negative rates and yield curve control because of the earthquake that we had over New Year? That is the view from Morgan Stanley. A very good morning to you, Danny Berger.
Good morning, Manus Cranny. Well, here is how you destroy hopes and dreams just in the space of 2 days. Manus, I feel like we had so many conversations at the end of last year that said, oh, it's going to be the year of small caps. Look at what the Russell 2000 did yesterday, closing down more than 2.5%, its worst day since the banks collapsed in March. That's not exactly a roaring endorsement for small caps for this market, but we attempt to do a rebound this morning. U.S. futures are higher, small cap futures are higher too. Europe is doing well. The only only fly in the ointment this morning does appear to be Apple. They have received another downgrade, this time from Piper Sandler, who's worrying about inventories. Apple, for its part, is down about 0.7 in the pre-market session. We'll show you that on the bottom of your screen in a moment. But of course, the thing that is bucking the trend, as it seems to love to do, is Chinese equities. CSI 300 down nearly 1%, despite bond yields at their lowest for 2020 on hopes of stimulus. It seems that property stocks, and at the same time, a Fitch downgrade of asset managers, bringing down the equity market in China. Now, Manus, when it comes to those FOMC minutes, one of the fascinating things is just how binary the analyst reaction were to it. I feel like you and I are a good microcosm of this, because you called me this morning and said, oh, they seemed hawkish, where I don't know if I've convinced you of this yet, Manus. I think that they were quite dovish. Instead, the market just front-loaded. And for my evidence here, this is the quote I picked out from the FOMC. A number of participants pointed to the downside risk that the economy would be associated with an overly restrictive stance. Manus, this seems like an FOMC that doesn't want to hold rates restrictive for too long.
And yet, if you look at the swaps market on the other side of that, it is convinced that we did get over-exuberant in what did Powell mean about dialing back. And I think where you are with the market at the moment is, yes, the market is still pricing in a total of 6 rate cuts. But the question now is whether they are backloaded and whether they really need more data. I mean, it was the data that saved the bond market in the end of the day. ISM prices paid, that helped the market. That came in at 45.2. You're also looking at, if you look at the rate cuts for March, Danny, they're dissipating ever so slightly. You're now talking about 16, 17 basis points for March, and that is well back from where we were, which was a full lock just a few weeks ago. Danny.
But even still, we are betting that there will be cuts in March. That bet still exists in the market, even though it's not 100% anymore. Let's now get to Wei Li, Global Chief Investment Strategist at BlackRock. Wei, when you look at the bets, again, as Manna said, they were pared back for cuts in March. Does that just need to evaporate? Is there a chance that the Fed is really going to be cutting in March?
Well, we don't think the Fed is going to cut in March, and market pricing for 6 cuts for the entirety of 2024 is a bit too overly hopeful for the Fed to come to the rescue of the economy. So we do think that this year is the year of rate cuts, maybe starting in Q2 instead of March, and maybe not as many as what market seems to be hoping for. So right now, we're talking about more than 5 cuts, close to 6 cuts, but maybe closer to 3, which is actually what the Fed is signaling themselves is what we're eventually going to get. So in terms of my takeaway from the FOMC minutes last night, what is interesting is that there was a nod towards financial conditions, which we didn't get in December, which to me reads a bit on aggregate more hawkish compared to the read back in December. But the big picture is that this year is the year of rate cuts, and we have become incrementally more constructive on duration versus through the course of last year. And we want to lock in some of those higher rates at these levels because yields are coming down, policy rates are coming down.
Manus, Wei says it's on the more hawkish side. I think you win this round.
Listen, I'll genuflect to anybody from BlackRock that's got a little bit more information and knowledge than me that I'll have in my little finger. Wei Li will have more of that any day of the week. Wei Li, good to see you this morning. What did you learn after 3 days of I mean, for me, I think it's cathartic to see this market pull back, bonds readjust themselves, equities just, I mean, you make the point very beautifully. You say that we are seeing a market pricing, a precise combination of a soft landing and central banks coming to the rescue. What did you walk away with after a little bit of a mini shudder these first couple of days? Any sort of first takeaways?
Well, actually, beginning of this year is a continuation of the trend that we saw through the course of 2023 in that markets could jump at one piece of information and really run with it, right? So through the course of last year, we have seen multiple really wild swings in terms of prevalent market narratives. And going into the year end last year, we had this melt up, really fueled by soft landing hopes. And at the beginning of this year now, so far year to date, there is a bit of a reset of that as markets rethink how many cuts we are actually going to get. So I think the bottom line here is that we should expect more swings in terms of prevalent market narrative because this is not your typical market cycle. is not your typical economic cycle, and it's very, I would say, confusing as some of the cyclical forces interact with structural forces, which is why having macro anchor is really important. And really, this is an environment where the room for differentiated macro insight is greater, and the reward for having such insights could be greater compared to before as well.
Well, it's also interesting because we're away from this world where everybody is tightening together. I mean, if you just look at the difference between US, China, and Japan, there you have three very different trades. Does that mean there will actually be diversification this year, that a portfolio construction is going to look different than 2023?
I think it's really important to think about portfolio diversification in the context of U.S. equity bonds correlation hitting almost the highest since the 90s by some measure, right? So correlation between equity bonds are very, very high through the last quarter, the last half of last year, but also as we kind of enter this year as well. And more broadly, the bottom line here is that bonds as diversifiers are less reliable now compared to before, as focus swings from growth fear to inflation falling down. So as we think about portfolio construction, we really got to go one layer deeper and one layer more granular as we look to build that diversified portfolio. So here you talked about potential policy divergence between BOJ and the Fed as well as PBOC, but we're also talking about an environment where the ECB and the BOE and the Fed are all looking to cut this year, and markets are pricing 5-6 cuts for all of them. So actually this is an environment depending on which blocks you're looking at, how you think about portfolio construction can vary greatly. And yes, of course, there can be policy divergence, but at the end of the day, what matters the most is still the Fed.
Right.
Yeah, I mean, where the Fed goes is going to define, in many ways, where the dollar lands, etc. When we talk about flow, one of the interesting things that have come from Bank of America is that it was hedge funds and institutions that piled over $60 billion into the equity market. Retail, ironically, this is the most surprising fact of all. Retail withdrew the most amount of money from US stocks last year since 2019. Obviously, that flipped into money markets. Where are you on this sort of halcyon view that the money market $6 trillion will come and save us all and carry this rally through? What's the BlackRock view? Because you see more flow than anybody.
Well, there has been a lot of flows into money markets. U.S. close to 6 trillion, globally close to 8 trillion now. But not all of those money market funds can go back into the risk assets. I think the broader dynamics around deposit and also around the overall liquidity environment because of QE mattered in that regard. So we actually monitor a lot in terms of portfolio allocation to cash, which is not strictly associated with money market, but this is actually the part of the portfolio block that could be allocated readily to risk assets. And here, based on our portfolio construction team analysis, looking at thousands and thousands of portfolios that we monitor here in EMEA, the cash allocation has tripled over the last couple of years from low single digit to high single digit. So there is a lot of cash to be deployed potentially as FOMO, fear of missing out sentiment, grasp investors starting this year. And I would also make one observation, which is that at the beginning of last year, sentiment was quite negative. Yep. There was a lot of fear around recession. At the beginning of this year, actually, it's a bit more positive compared to last year. So I think there is some fuel to keep momentum going. The year-to-date reset notwithstanding, but over a broader, longer-term horizon, I think it's important to recognize that starting this year, markets are priced for the perfect combination of soft landing and central banks coming to the rescue in a meaningful way. And I think there is some adjustment to be made, which is why we are very selective in terms of how we want to take advantage of these opportunities.
Weili, thank you so much. Great context around the cash. The best phrase I heard all last week when you two were on holiday, which was weaponized FOMO. That's what we've suffered from. Weili.
Things happened when we were on holiday.
Holiday. You two were on holiday. I was working. Weaponized FOMO. Weili, thank you very much. Weili from BlackRock setting the tone on the cash allocation. Danny, some of the stories that are trending on the Bloomberg terminal this morning. Donald Trump has asked the U.S. Supreme Court to overturn a ruling that would bar him from the presidential ballot in Colorado, setting up a historic showdown over whether his role in the January 6th assault on the Capitol disqualifies him from office.
Nomura will lift pay for its young employees at the flagship Japanese brokerage subsidiary with an average 16% pay rise. That's much higher than local inflation. The pay rise comes as a sign of intensifying competition to retain newer recruits.
Well, French inflation edged higher in December as service prices grew more quickly and energy costs jumped after the government pared back its support for households. Coming up this Thursday morning, tensions in the Middle East rise amid the deadly explosions in Iran. We'll discuss the very latest right here on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We think there's 30% chance of a no-kidding, real material disruption in oil and LNG flows from the region. 30%. I would say the market is closer to 3%. So we think events will cause the perceived risk to go higher because everybody is in escalation mode here. We're likely to see more escalation, stepped up attacks, and as a result, the market's going to sort of be dragged back to this bullish Middle East risk.
Rapid founder Bob McNally with yourself and myself yesterday, Danny, talking us through that he thinks the market is underpricing risks from geopolitical tensions in the Middle East, and the subsequent 24 hours or 12 hours prove that very, very much so. We had the 24th attack on a commercial vessel in the Red Sea, and then, of course, you had the escalating situation inside Iran as well.
Yeah, and then there were also supply disruptions in Libya, adding to all of this. But I got to say, with all those three things coming together, Bob McNally told you and I yesterday, the premium should be $12. We didn't get an additional $12. We're still under $80 a barrel. Perhaps you look at someone like Goldman Sachs, who says that the war premium actually is something like $3 to4 a barrel. I suppose that's what makes the market, but it's really the supply question, perhaps, not letting us move as high as one might think.
Yeah, I mean, we are bid this morning up 1 1/3% on NYMEX crude. The issue comes down to this. We've got 900,000 barrels of additional cuts coming into the market live from the OPEC Plus family. Ironically, it's the UAE which delivered the biggest cut last month. They cut by 70,000. You may say, oh, that's nothing compared to the scheme of things. But this is about the process of adherence to the rules within OPEC. They are much chastised over this, but it's about what is the UAE and Saudi doing. And Angola came on side as well in terms of their behavior, in terms of hitting the quota. And that mounts on the supply side narrative, containing the supply side. Danny.
Right. But of course, the fear of a supply disruption remains very in the present with concerns on geopolitics. Let's talk about what happened in Iran, because blasts in central Iran have killed nearly 100 people, adding to risks the war between Israel and Hamas will widen into a broader regional conflict. It comes as more than a dozen countries warn that the Iran-backed Houthis against further attacks in the Red Sea. For more on this, let's bring in Roz Matheson, Bloomberg's EMEA News Director. Roz, what do we know about these blasts in Iran?
Well, we know that they came, of course, around the 4th anniversary of the killing of General Soleimani, who was killed in that US drone strike around 4 years ago. So it's a really important moment for Iran. It's a very sensitive moment for Iran. It's a very, very sensitive site for Iran. So, of course, it's quite embarrassing that these attacks happen. Interesting that Iran was willing to publicize them. We don't know a lot about who was there, who was killed, were there senior Iranian officials there for those ceremonies who may have been killed in those attacks. That we don't know. Iran has been saying, of course, that this is because of their opposition to Israel. They haven't directly pointed the finger at Israel or the US as a result, but certainly putting that in the ether, and the US is saying it's far too soon to say. But what that does is raise the possibility, again, that Iran has to do something to respond. Does it do that through a proxy? It's got so many of them in the region. Again, as we saw after the killing of General Soleimani, an attack on forces in Iraq instead. Does it do some kind of calibrated response? Or does this come to the point where bit by bit all these countries are getting drawn in to this conflict in the region, Iran, the US and others, despite possibly not really wanting to?
And it's interesting, you've got the US State Department, Matthew Miller, saying no reason to believe that Israel was involved, and the National Security Council spokesman, John Kirby, at the White House saying, of course, echoing sympathy for those who were killed. We touched on it when we were talking about the oil prices, and I think this is much more prescient in the oil and the trade routes. The Red Sea, dozens of countries have put a joint statement together condemning these Houthi attacks. So does this now sound like it's a coalition of beyond the willing, but a coalition of protection that's really prepared to take action against these Houthis?
Well, that is really the question. Where does this coalition begin and where does it end? Right now, what they're wanting to do is really protect shipping in the area, and that's primarily still the US, with some other major countries involved also. And that's about sort of shooting down drones and missiles that are flying through the air. That's not about hitting Houthi targets on the ground inside Yemen or coming on shore into Yemen. And that's something even the US is highly reluctant to do, is to get drawn back in on the ground in Yemen. But it might be at some point they have to hit some targets in Yemen to make a point, because as you were saying, the longer this goes on, the more protracted these delays are. That's really the thing that people are looking for when it comes to the oil price. I mean, we've got protests and supply disruptions in Libya, but those are kind of small and momentary, really, in the scheme of things. They're adding to tensions, but it's really about how long do these disruptions go on for and how much does that affect supply going forward.
Right. Roz, thank you very much for joining us this morning. That's Bloomberg's EMEA News Director, Roz Matheson. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it is then the market forces and the business incentives of global companies that transform that EU rule.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
You're watching Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Manus, we've got another Apple downgrade. Earlier in the week, it was Barclays warning about iPhone sales. Now the shares are down yet again pre-market. This time, Manus, it's Piper Sandler downgrading Apple.
Yeah, I mean, this just seems to be people trying to get in and get ahead. They talk about inventory concerns and that weakening China economy. But of course, I'm going to give you the other side of this trade, which was we had a long conversation with Dan Ives from Wedbush, and he really really lashed back against the Burrs who were so doom and gloom on China. He said it would see the way through and there would be a $4 trillion valuation. And if you look at the analyst calls at the moment, 33 buys, 15 holds, and 5 sells. So Piper Sandler goes to neutral with a target of 205.
Right. Well, I mean, they are talking about weakness in iPhone volumes, basically saying that there's not enough demand for the new iPhone 15. I actually helped too. I know I've told you I have a 12. I bought my significant other an iPhone 15. So even if not for myself, that's how selfless I am,
Did you pay for
I buy
this?
iPhone 15s, but
there's another significant
I'm not made of money, Manus.
Who's he?
Oh, I'm sorry. What a way for you to find out. This is awkward. Anyway, should we talk about TikTok? Let's change the subject. Manus, there's a really great story out on the Bloomberg terminal that TikTok is aiming for this really huge sum for their online sales, $17.5 billion. The upsum of this is that Amazon should be shaking in their boots, that TikTok is coming for their e-commerce business.
Listen, never mind Amazon worried. Do you know what I'm worried about? This is like Nirvana for you. This is like you're going to run off, become a TikTok sensation, right? Sell those earrings. You're going to leave me. I mean, this is all just projection. You're going to leave me. You're going to be a merchant on TikTok. You're going to leave TV. The bottom line is, of course, you know, they're coming after Amazon's lunch, but they're not going to do it without upping the fees. For merchants like you, they're going to charge 8% for those earrings. We'll talk more about those earrings.
I mean,
she got a million views. She got a million views on her earrings clip on TikTok.
I am tempted.
Yeah.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Investors pare back on their rate cut bets, with Fed minutes showing policy will remain restrictive for some time. Treasury steady after a 2-day sell-off. Mounting tensions in the Middle East, twin explosions in Iran kill almost 100 people in the city of Kerman. No group has claimed responsibility for the blasts. Over in China, 10-year bond yields dropped to the lowest level since 2020 amid rate cut bets. Onshore yuan falls for a third day. We are attempting a turnaround today. How strong will it really be? S&P futures up 0.1%. Russell 2000 futures up more than 0.5%. And that's because this thing got killed in the cash trade. It had its worst day since March during the bank failures. But we also saw the NASDAQ post back-to-back 1% declines. This is my fun fact of the day. That's only the third time in history that the NASDAQ has started out the year that way. So as we attempt to rebound, the one standout, as it tends to be, is China. CSI 300 ending the session down nearly 1%. Minus, there are those hopes for stimulus, but at the same time, there was a downgrade from Fitch on some asset managers. There's also concerns about property stocks. So the divergence is certainly in this morning.
Well, the bond market and the equity market only heard one message, which was rates would be restrictive for some time, and that has caused a repricing. The bond market in the very first instance sold off, and then it was saved by the prices paid within the ISM data, and of course the JOLTS data all added to the narrative. There you go. How exciting can you make a bond board at 5:30 a.m. and 43 seconds, unchanged on the very, very short end? But the very short end has decided to recalibrate. It now believes that you're possibly going to get 17 basis points of a cut in March. So the narrative is this, about pushing the rate cuts further out into the back end of the year rather than perhaps front-loading them. Oil is up over 1%. We spent a little bit of time talking about this. There's the Houthi rebel attacks. There's the outages in Libya. And, of course, the blast in Iran, killing over 80 people at this juncture. So you have a trifecta of geopolitics and supply, a fairly toxic mix. Again, underpricing the risk here of geopolitics would be the view from Rapid. What happens with the Fed will define the narrative for the Bank of Japan, but also those natural disasters like the earthquake over the weekend may delay. Morgan Stanley may say they may delay the Bank of Japan moving to that normalization position. So you've got a very, very short end of the curve, fairly unimpressed at the moment, and dollar yen just trading a little bit higher by 0.5%. Danny.
Yeah, it's funny you talk about the Fed really dominating what happens with the yen, because when I said to Wei Li, hey, Wei, what about all this divergence we're seeing between the extra easing in China, some hopes of easing in the U.S. and Japan? She basically was like, Danny, stop trying to be fancy. It's all about the Fed, and it's all about the FOMC yesterday, and this market perhaps over-egging how many cuts that will really happen.
Yeah, and the bottom line is, When will those cuts begin? And we've moved on. There was almost like a catharsis in many ways that we saw the minutes. I still go back to the point that Jay Powell communicated something in the middle of December, which was about the potential of the propensity for rate cuts. We got over our skis in terms of interpreting that, when they would do it and the size that they would do it. And that's what markets do. They overinterpret, and they're perhaps a little bit over-exuberant, which takes us, of course, to the start of the new year. And that's what we saw, and I'm picking of that. Stocks were beginning to reshuffle the deck, really. Last year's worst names were up, and the best were being reevaluated by investors. Could this be a challenge to the bull market? Let's bring in our guest, Jay Woods, Chief Global Strategist at Freedom Capital Markets. I said it was a good catharsis, 3-4 days, reevaluate. You know, nothing in this world is a straight line trajectory. Do you think that there is going to be a rebalancing from those laggards to love, or inverse?
Well, I think we've seen it in the last 2 days. The rotation has been utilities and healthcare leading, and what was lagging last year, I mean, it's just like they turned on the switch. But you have to put it in perspective. We just had a 9-week winning streak. The Russell 2000 was up 25% from its October low in 2 months. It's pulled back. These are normal retracements. When you live through it and then have some negative headlines behind it, that makes it a little scary. But right now, let's just put things in perspective and enjoy this rotation and look for where the strength is. Some of those Mag 7 names, they've come in a little bit. That's okay.
I think that's just possibly. Here's my fear: is that Danny's going to run away. She's going to run away to TikTok, become a TikTok star, sell not just earrings.
I'm tempted.
Yeah, she's got. I've got a good authority that she's clearing out that wardrobe and selling a lot of other things. But Amazon is your top tick. So you're not too worried. Sorry, Danny. Yeah. You're not too bothered. You're not too bothered about ByteDance at this stage. Why are you so bullish on Amazon?
Amazon, to me, first I always look at price action as a technician, and then the fundamental story behind it still rings strong. So Amazon, when I look at that chart, it just got back to its 52-week highs. It still hasn't made the full roundabout like some of the other Mag 7 stocks have made. Yeah. I still think maybe Andy Jassy wasn't getting the love in his first full year at the head. And from a technical point of view, if it stays above 145, I think the risk-reward setup is very favorable, and it should challenge by mid-year that 185 level where it was sitting at all-time highs.
See, I kind of love this because I want to buzz market my stuff, but Manus does it for me.
What's
so
a buzz
it's
market?
Like yeah, kind of, right? You're like, Danny's selling some of her clothes. I'm not going to say on what platform because I feel like that's taking it too far. But Manus like really buzzing all my side hustles. I really love it. But to that point, Jay, I mean, at some point, does Amazon need to worry about TikTok coming and taking its lunch? Or for you, is that just a story that's so far away, it is not a concern at this moment?
Yeah, that's not a concern at this moment. What Amazon is doing, what their strengths are, and they continue to build upon, they've expanded into groceries. They're coming after Walmart. They're coming after the Uber Eats and the DoorDashes of the world. Their AI story is really yet to be expanded upon, and I think we'll see a lot more of that in the next couple quarters as they report. So any threats from TikTok or of the like, right now, I don't think that is a major concern going forward.
Just for full disclosure now, Danny Bright, you know, she makes me feel bad. She makes me feel that I'm sort of like out of some sort of side hustle for her. When I was leaving Dubai, the one thing that I didn't sell was a dining room table, which is now in storage because New York apartments, here's a shock fact of the day. Yeah. It's not the size of a Dubai apartment.
Tiny.
Let's just park that. Citigroup got a big boost from Mike Mayo.
Yes.
He took JPM off the top of the pops. Mm-hmm. Okay. Remember that show?
I don't remember that show.
British
culture. Too British.
Too British, and I'm Irish. Okay. Citigroup got a massive boost from Mike Mayo. It's his top pick. But you slide in with JPM and Bank of America. Where do you come down on this dilemma?
Well, next week we get the financials reporting, and I think that's very important because there's been a lot of noise, and now we'll get to see some results. JP Morgan, I think, is best of class. It was up 27% last year. It's the leader in the group, and now I think we're going to see some people follow along. But technically, JP Morgan just made an all-time high yesterday. we didn't really hear that headline going forward. It could pause here as we go.
We did on Bloomberg Brief.
Okay, well, I apologize. I must have missed that headline on the brief, but from a technical point of view, the way it's set up, and if you think about it, it's making all-time new highs in a M&A environment that hasn't been strong, IPO market that hasn't really come to life. The last 2 years haven't been there. So the setup, to me, as things pick up, and as the Fed tailwind helps them along, is good. And then speaking of Citi, Citi and Bank, they both report next week. Bank America just broke out of a nice little downtrend. And on a weekly basis, you want to back these stocks out, especially Bank and Citi, because where they're coming from, they haven't done too much. If you go back to the financial crisis, especially. Remember, Citi had a 10-for-1 reverse split. That was in 2011. It was trading at 45. We're $8 higher than that, 12 years later. So that call that Mike Mayo made,
that worked.
Hey, listen, I think that call that Mike Mayo made is actually a wise call. Over 3 years, he said. It's not going to double tomorrow, but the setup is there, and that's what I like. And now the financials, they turn. They don't turn quickly. It's not going to be fun like the tech rally, but the direction is starting to change. The tailwinds are there. And I think the risk-reward setup over the long term, we're talking a year, 2 years, 3 years, I think the financials are a smart place to be, and the rotation is clearly coming there.
Well, Jay, I want to talk about the fun stuff. I want to talk about the tech rally, or maybe lack of one, specifically with Apple. What do you make of some of these analyst calls that are piling up? Earlier in the week, it was Barclays. Today, it's Piper Sandler warning about iPhone sales. Are you concerned about Apple?
Yeah, I mean, technically, it has a little bit of a double top going here. Yeah, 2 downgrades to kick off the year is not how you want to start things. We'll see how it cycles through the earnings season. Apple to me is more of a utility. I mean, it's just constant. As you talked about in the last segment, you upgraded your phone finally. Yep. Congratulations. I have to do that myself. I know.
She did.
And I know. I thought she bought it for you. I'm so sorry she broke that bad news to you.
She breaks my dreams every day.
I know. But listen, Apple to me is a long-term holding that you buy, you put away, you don't worry about. Yes, there's a lot of noise.
I was going to say, Jay.
Yeah.
Jay, you broke my heart this morning when you said you missed something on Bloomberg Brief. I'm now convinced the only way you watch a show is when we invite you on. So now you're just going to have to come on every day, I think.
I would do that for you guys. That's how much I feel about Mattis over here.
Jay.
And,
And me?
Of course you. I thought that was without saying.
I'm warning you, buddy. You want to tread really carefully now.
The Apple point. Apple, to me, yes, it's going to be going sideways for a little while. We'll see how it shakes out over earnings. The China concern is real. I saw the Dan Ives interview. Thank you very much. I do watch. And anytime Dan speaks, I listen. And, his optimism, I think, is something that rings true. And over the long term, I don't worry about Apple, but the day-to-day, for the day traders, he could pull back a little bit, watch the 200-day moving average as support, but over the long term, it will find another leg higher.
Jay, excellent thoughts. You have fully redeemed yourself in my eyes with that. Hey, I'll see you when I'm in New York shortly. Jay Woods there of Freedom Capital Markets. Always such a pleasure to have you on with Manus and me. Okay, coming up, Chinese 10-year yields fall to the lowest level since 2020. We're going to have more on what's happening in China next here on Bloomberg Brief.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The data is in, and the China services sector climbed to the highest in 5 months. Now, at the same time, Chinese 10-year yields hit the lowest since 2020 as its recovery remains under pressure, and there are hopes potentially for continued stimulus in what's already a very easy policy accommodation. Joining us now is Bloomberg's Sofia Orta y Costa. Sophia, I'm going to start with the question I always ask you. What does this data mean? Please define it for us.
Yeah. So it's a lot better than expected, or a lot better than the previous number. And essentially what this suggests, I mean, services is not a huge chunk of China's economy, not like here in the UK and not like in the US. So manufacturing is a lot more important. This is a private survey, so it's mainly the coastal regions, mainly the southern regions of China, and mainly the export-driven regions. So it actually tells us a little bit more about the global economy and demand there than it does about China's domestic economy. But it does offer a glimmer of hope. I mean, it was the strongest in a long time since last year, since early last year, since July. And it does suggest that people, importantly, that companies are hiring. And this is one point that I really like to highlight because, you know, this has been a really big factor when it comes to consumer sentiment, is the outlook for hiring. Unemployment, youth unemployment reached a record in the summer last year before officials stopped publishing the data. So if companies are hiring, private companies, then maybe we could really kickstart or get China out of that negative bias when it comes to consumer sentiment. I think that's the glimmer of hope, Demi.
Well, let's see whether the newly employed spend their money on aspirational luxury and help luxury push through a few price rises and sales. But herein lies the point, isn't it? This time last year, if we go back 12 months, it was the great China hope for the world, for the global economy, etc. Now, we did fine. Not exceptional, but, you know, it was a strong year of growth in the United States of America and in the rest of the world, perhaps a little bit less so in Asia. Where is China's impact? Is it on the global deflation or on global growth? Which do you think it's going to export the most to us?
Exactly, Manus. I think the surprise, perhaps, also was that, you know, a lot of people this time last year expected China's reopening to be not only good for global growth, but bad for the inflation picture. So there was a kind of risk there. I mean, I think that the fact that China's still exporting deflation, that's good for the disinflationary picture that's taking hold right now, a narrative that's very strong in markets despite the kind of jittery start to the year. But in terms of global growth, I'm really interested to see what kind of target we're looking at for GDP this year, because the 5% growth target that officials announced last year in China, that was seen to be far too low given the low base base comparison. It's a much higher base comparison this year. But if officials go again for 5%, that suggests that we will get more stimulus, because without it, it's unlikely to happen. And it also suggests that Beijing does want to kind of reinforce a more, an outlook for stability in the economy. And I think markets will receive that quite well.
Okay, Sophia, thank you so much. Sophia Acosta on the very latest movements in China. Turning to Wall Street, the Basel III banking rules are likely to change before being implemented. That is according to Morgan Stanley's James Gorman. Let's take a listen to an exclusive interview with the chairman.
There have been thousands of comments put into the various regulatory bodies led by the Fed. It was a proposal that I would say was extremely aggressive and set a marker. It will not go through in that form. If it did, I think it would have very, very negative consequences for corporate lending across this country, which is not what you want. It's not going to help the economy grow.
If the Republicans take the White House in 2024, whether it's Donald Trump or another contender, do you expect that this tighter regulatory environment will just fully unwind?
It's too hard to predict. I think we're in, you see pendulum swing, and we swung to lighter regulation to, I think, an excessive proposal. I think it'll swing back. So it's heading back to more balanced regulation. And that's where it should be. I'm all about balance. The banking system should not be deregulated. That would be a nightmare. On the other hand, if you over-regulate and you require capital standards that are so high that the banks are uninvestable, they can't grow. That doesn't serve communities well. You need prosperous, thriving banks to provide lending products for small businesses and consumers.
To the extent we're less than a year away from a spate of bank failures, to the extent that there are still fragilities in the financial system, what are they?
I don't think there were a spate of failures, honestly. I think there were 3 banks that got it wrong. I've said that publicly. They made choices that were the wrong choices. Wasn't complicated. They got washed up and cleaned up and folded into other banks, and you move on. This wasn't, people kept telling me we're having a banking crisis. I said, no, we're not. We had a crisis among 3 banks. It was a crisis for their shareholders and their employees. It's not a crisis for the market. The core banking system is in rude good health, to use a British expression.
Well, it's not just the banking system. If you think about the hedge fund industry, regulators are also very concerned about some fragilities there. It wasn't too long ago that Morgan Stanley lost almost $1 billion in the wake of the collapse of Archegos. Do you think that there needs to be more safeguards on the non-bank system?
I mean, honestly, there's too many participants in the non-bank system to say yes or no. You'd have to go subset by subset. Are we talking about payments? Are we talking about private credit? Are we go through each of the pieces of it? But there are always risks when you're dealing with leverage in a financial system. But if you don't have leverage, you don't have lending. So it's a balance. Again, I'm always back to there is a balanced solution to most of these debates, and you can find it with thoughtful discussion with regulators.
Speaking of leverage, the cost of leverage is higher today than it was a couple of years ago. Where do you think interest rates go headed into the end of the year, and what do you think the market starts to look like through 2024?
They go down.
As simple as that?
Yeah.
How far down?
I've got no idea. I mean, I thought that unlikely the Fed would cut rates this year, but inflation has moved down pretty materially quickly, that it's now become more likely. So first half of the year, I suspect nothing. Back half of the year, they could easily move a couple of times. But the key point is, we started this journey with inflation at 10%, rates at 0, unemployment at 3.5%. And my objective was to get us to 4, 4, and 4. 4% inflation, 4% rates, 4% unemployment. We're about 3% inflation, we're 5%, 5.5% in rates, and we're about 3.5% in unemployment. So rates will come down.
Do you think the economy is in an all clear when it looks like a soft landing versus a hard landing? Do you think that the economy will survive this year in good shape?
The economy's fine. I mean, there's this obsession with the R word, recession. I mean, you have recessions. They come and go when you get imbalances between unemployment rates and economic growth. So, no, the economy is doing fine. I personally think it is unlikely we'll have a recession. Very unlikely we'll have a hard landing. But we'll see. But the odds are clearly in favor of a soft landing. I think the Fed's done a great job.
Man, I love that. It wasn't a banking crisis. It was just a crisis for 3 banks. That, of course, was James Gorman, Morgan Stanley Executive Chairman, speaking with Bloomberg's Sonali Basak. Okay, coming up, Manus and I are going to get you set up for the day. We're going to look at some of the market-moving events that you need to watch right here on Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day. Here's what's ahead this Thursday. We're going to have a slew of economic data coming out of the U.S. First, jobless claims and ADP unemployment numbers will come at 8:30 a.m. Eastern. Then investors are on inflation watch as service and composite PMI numbers for December. That will come out at 9:45. And then we're going to kick off the new year with earnings. Before the opening bell, Walgreens is going to be reporting its first quarter results. In the meantime, Manus, what's moving in the pre-market?
Well, we got a little bit of Tesla because guess what? Cathie Woods is back in the market. She is loading up on Tesla. I was actually just looking back at what she spoke to us on surveillance about last week in terms of still full bull on Elon, and she is, and it's GM and the others stepping back from the production in electric vehicles. So Cathie Wood is in there. She is buying and a full believer again in Tesla. So, you know, primed to grab more market share.
Yeah, and I mean, it's an interesting time because it does seem like the rest of the market has started to sour. I'm looking back so far this week, it's down 4%, but of course the whole market is. The last week of the year was down more than 1.5%. Some of the concern is the competition. We talked about this yesterday, Manus, that BYD surpassed Tesla as the biggest seller of EVs. So maybe the traditional buyers are stepping back, but China's now coming for Tesla's lunch.
Yeah, but there's a short, it's interesting. There's a great story this morning about the short interest on BYD. So for all that euphoria about BYD snapping at the heels of Tesla, you know, maybe we've gone overly full bull on BYD. Great conversations this morning. They continue on Surveillance.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Are you in recession or are you not in recession? And we have a very low probability of recession this year.
We are not out of the woods when it comes to battling inflation.
The pain trade is that everybody thinks that inflation is fully vanquished.
Either inflation falls because the economy continues to weaken or the economy stays strong.
What we need to focus on is what's happening with the data, and what we need to understand from the Fed is it only inflation? Or are they taking into account a slightly softer economy?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly positive on the S&P by 0.1% after a soft start to 2024. TK 3-day losing streak on the S&P. Make it day 4 for the NASDAQ.
Tangible, but still not to support yet, John. I think there's a lot of different opinions here. There's a lot of people out there that were more cautious in the market saying, see, this is what you get after that bang up fourth quarter. What I'd say is we're starving for a narrative, and to me, what Thursday is, it's adjust the narrative Thursday and Friday. We're going to feel a lot different at 8:31 tomorrow.
The economic data taking shape over the next 24 hours. Jobless claims coming up a little bit later. Payrolls coming up tomorrow. Fed minutes yesterday afternoon. Not much for the equity bulls to get their hands around. Lisa, some of the commentary coming from Morgan Stanley. Not cutting anytime soon. From Jefferies, attempting to put the toothpaste back into the tube.
And completely failing. Let's be completely honest. They did not succeed in really sending any kind of hawkish message. Maybe on the margins, they're saying, yeah, optionality, words, words, words. But at the same time, really, to me, what this highlights is that they really stand behind the message sent. But this stood out. Many participants remarked that an easing in financial conditions beyond what is appropriate could make it more difficult for the committee to reach its inflation goals. Suddenly, they're worried about financial conditions again.
You beat me up so badly yesterday. I actually looked at the minutes. There were 425 people in the room. A lot of Zoom call there, I'm sure. Did it move the market? I tried to discover when the minutes were released, did it mean anything to equities, bonds, currencies, commodities?
Should we feel guilty that we forced you to read the minutes? Is that basically
I didn't read the minutes. I read who was there.
Okay,
it's
great,
like
okay.
It's like when there's a state dinner.
To page 7.
No, it's like a state dinner at the White House.
All
Do you
right.
look at the menu or do you see who's there?
It doesn't move the needle in any kind of material way, but it does highlight this point that the uncertainty is there, that the Fed officials want to push back, and financial conditions matter again. Did it move the needle? No, not
Let's
at all.
talk about a single name, Brano. Let's talk about Apple in the pre-market. Another downgrade for Apple. This time from Harsh Kumar of Piper Sandler, downgrading the stock to neutral from overweight. We're down 0.8% in the pre-market. They say valuation concerns and broader handset and macro weakness in the first half of 2024. Now, Lisa, what's important about this, if you plot the calls from Harsh Kumar over at Piper Sandler, they've had a buy on this stock since spring of 2020. And that was when this name traded in the 60s. Now we're at 182. It's quite a move from someone who was an Apple bull.
The pile-on continues, and this comes after 4 straight days of declines for the NASDAQ 100, which is the longest losing streak going back 2 months. Here's the question. Is Apple its own story, or is it going to drag down the rest of the tech complex? We've been talking about the dispersion within tech that we're expecting, and yet you have seen a real moving in tandem in that sphere.
I'm saying people are in support or resistance. Apple is not. It's a tangible 5.6 standard deviation move from the peak that we saw about December 13th on down. And John, we are down 3.2 standard deviations in Apple. That is truly tangible.
I keep doing this. We have to frame it with last year's price action. So yes, we have pulled back, but we still had a gain of almost 50% in 2023 for that single name. Let's get to the price action more broadly. The scores look like this on the S&P 500, positive by 0.1% on the S&P. Yields up again by 3 or 4 basis points, 395.35, getting closer and closer, Lisa, to 4%.
Yeah, but not reaching it as it's really kind of quiet in the yield space. This morning, we're looking at data out of Europe as well as the drumbeat to the jobs report tomorrow. We get German December CPI at 8 a.m. Eastern. This comes ahead of European CPI data that's more broad tomorrow. Here's the question. What is the threshold to really stymie the rally that we have seen in 10-year bonds with yields coming in materially from the recent high? We've been on a round trip. We do see some sort of disinflation continuing in Europe. Today, ADP comes out, the employment change for December at 8:15. Always, no one cares until they do. 8:30 a.m. initial jobless claims. Yesterday's JOLTS data was interesting, and not because of the headline number, but because of the so-called quits rate, which ticked down to the lowest in September 2020. I am watching indicators like this to sort of key off whether we really are seeing a softening. And at 9:30 a.m., the S&P Global U.S. Services PMI may be more instructive than manufacturing, which remained in contraction for, what, the 19th month straight? And
Something
nobody cared?
like that. End of 2020, late 2022, late 2022. It's been in negative territory, sub 50.
And somehow the commentary around it was positive because it's sort of improving. My point is that it really has been sort of a non-issue, even though traditionally it has been. Services really is what you need to be watching.
I'm pleased you brought up JOLTS because I'm with you. There is a difference, and you can decide where that line is between a welcome cooling in the labour market and an unwelcome deterioration. I think it speaks to that data just yesterday.
Here's the thing. At an inflection point, it's hard to know whether this is the beginning of a dramatic swoon in the labor market or whether this is just the gradual softening that's needed to bring inflation down. That's the uncertainty that's causing a lack of narrative. And that's really what I'm trying to get my head around.
I got a yield call of 3%, and 10 minutes later got a yield call of 5.5%. I think we're all looking around for a narrative, and you make your bet and you're in play. A lot of the people are in play in the markets, and the crew has had a hell of a 48 hours. I mean, did you see what they did to Dan Ives yesterday?
Versus a pretty brutal 365
I think Van
days
Nuys is
for.
wearing black all day. I mean, he's got, the black Air Jordans
Morning
on
the
and-
losses in Apple.
No, he's got pounded
Over the last
yesterday.
couple of days.
The
Doesn't
Bears
have
went
black.
after him on Apple.
I think
It was
he has any
harsh.
black.
I don't know. I doubt it.
I don't think he has any black in his
doubt it.
wardrobe.
No reason to after the gains we saw last year. Let's kick off the conversation this morning. Ben Gutteridge joins us now, Investment Director at Invesco Investment Solutions. Ben, this line from you: recessionary risks are material for 2024 as prior rate hikes bite. Is that just last year's outlook reheated, or is there something different about 2024?
Hello to everyone. Happy New Year. That comment still holds. I mean, the context of it is one of a positive view on equities and the economy, but like the risk to that view one of the risks is the recessionary threat. I think the conditions are in play for continued, recovery and gains in equity markets, resilient growth, fading inflationary pressure, accommodative policy, or incrementally more accommodative policy, and that feeds our positive view on equities. But yeah, I mean, businesses, consumers, it's not all about mortgages, overdrafts, credit cards, auto loans, they're going to roll into new, more punishing rates. And so, that could bite and will bite harder into consumer confidence.
Ben, on an allocation basis, and let's base it off a standard market with 60-40 basis, what is 60-40 going to do this year? I mean, is there in play there? Can bonds actually give me more than a coupon?
Well, I think a 60-40 portfolio is a compelling place to start. Certainly relative to prior years. That disinflationary narrative that I sort of talked about, of course, doesn't just support equities. It directly supports bonds as well. And certainly, as we refer to the previous answer and talk about one of the risks to the equity market is a recessionary threat. Well, of course, provided you have lots of high-quality bonds in there, and certainly just some duration and some government bonds, that 40 should do materially better than it has done in prior years. So, I think it's a good place to start. Certainly, some adjustments needs to be made within the 60, within the 40, but not a bad place to begin.
Well, the adjustments that are going to be made, are they going to be made off economics, or are they going to be made off traditional securities analysis on revenue growth guesstimates and earnings guesstimates? I mean, the media loves to play the Fed game, but is it germane this year?
Well, I think that the Fed game will continue to create noise and uncertainty in markets, but it will be the data that ultimately drives markets. And if that disinflationary narrative, holds and growth remains resilient, and the Fed can cut a couple of times, then markets, I know November and December will have delivered a lot of the gains at the back of that narrative, but the gains, it should be still be a positive environment for equities in that outcome.
You talk about 60-40, and I'm glad that Tom brought this up, and you said it's a good place to start. Yesterday, we heard something similar from Phil Camparelli, who said we can finally play defense again with bonds. And yet, Bespoke Investment came out yesterday with this chart showing that bonds and stocks have moved in the most positively correlated manner going back to 1998. This has continued regardless of some people's calls that 60-40 can be resurgent. How concerned are you about that the relationship has been irrevocably broken?
Well, I think that there are risks to our investment strategy and to a 60-40. The most perilous would be a return of the conditions that we saw in 2022, heaven forbid, and that would be a reflationary, an inflationary resurgence, because of course that's damaging to both bonds as interest rate hikes are back on the table, and then you're thinking about a more material recession as well, because we're starting from such a high level on rates. So, yeah, I mean, the thing that gives me the most anxiety is perhaps a cut that comes too soon from central banks, and given labour market conditions where they are, maybe that injects too much confidence. And as I say, inflation back on the table, rate hikes a possibility again. So that's the thing that worries me the most for a 60-40 rather than a recessionary threat. Clearly, it's not as hard to envisage 60-40 is going to be making much money in and around the onset of a recession, but it would be reflationary pressures returning that would cause us the most trouble.
But before we let you go, I am curious how you treat some of the geopolitical news that we've been getting every morning, because some of the headlines have been increasingly inflammatory. How much can you trade off of some of these rising concerns about a broadening in the conflict in the Middle East?
Well, that is a very difficult question to answer. I don't want to appear reckless to it, but the geopolitical challenges, if you anchor your investment strategy to geopolitical challenges, that can be a touch reckless too, because they're very difficult to predict. And at the moment, it's very terrifying news, but it looks as though things are being contained. Markets are relatively sanguine to it, but it's important to have a hedge in place. And of course, the key risk is that you get the oil price surging back, and that would be reflationary, bad news for 60-40. But maybe some parts of the capital markets can perform a little better, going long break-evens, going long energy stocks, going long UK equities. We think that's a decent hedge against a resurgence in inflation in the oil price. But we wouldn't anchor investment strategy to geopolitics, but certainly put some hedges in place as a consequence of it.
Energy stocks outperforming in yesterday's session. Ben, thanks for that. Happy New Year, sir. Ben Gurridge there of Invesco Investment Solutions. Crude, biggest one-day gain going back to, I think, the middle of November. Adding to some of those gains this morning, Lisa, up by almost 1% on WTI, $73 and about 40 cents.
And this comes after some pretty fiery rhetoric out of Iran after the attacks during the funeral, during the commemoration of their top commander from 4 years ago. What I'm looking at right now is whether there is this knee-jerk response to any escalation in oil, whether it can stick, since it hasn't so far.
Well, it hasn't so far, but look where we are. We were going to 90, 24 months ago? We were modeling in 110, 120, Pacific Rim demand, etc. And we're still awaiting that. Now, maybe we see it this year. Oil, to me, is the single toughest thing to call, John. I think there's some pretty good academic research on that.
That's always the way.
But the answer is, I haven't looked at the fancy charts, but the answer is oil's been a gift. I'm seeing across America a lot of under $3 a gallon. That's, John, it's not in liters, excuse me. At least translate the liters.
This goes back to the number we repeat every single morning, 13.3 million barrels a day of crude production in this country. That helps. My academic research, my conclusion, Tom, and all of that, if you want to make a fool out of someone, ask them for their year-end crude forecast. Usually the way of doing it. It's tremendously difficult to do.
Other question, it's a British question, it's a European. Can I fit in the little cute Fiat? One drove by me on
the
Fifth
Fiat
Avenue.
500.
Yeah, is it like the smart car where you can fit in it?
I'm going to say no, based on the fact that you get annoyed about Chevy Suburbans.
I do, yeah.
Having enough headroom. So
it's a cute car.
I'm going to say no based on that. From New York City this morning.
Petrol.
Good morning.
source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
We have no indication at this time at all that Israel was involved in any way whatsoever. Everything that we've done, in fact, the laydown I just offered of the force posture changes that the president has ordered in the region has been designed to prevent an escalation or widening or deepening of this conflict. As we've said before, we don't want to see it widen beyond Israel and Hamas. And again, we're going to keep working with partners in the region to prevent that from happening.
That was John Kirby, the U.S. National Security Council spokesman, addressing the recent blast that took place in Iran, killing at least 84 people as fears of a larger Middle East conflict continue to escalate. Ed Mills of Raymond James coming up very shortly. Stay tuned for that. I just want to touch base with a price action for you. For those just tuning in the equity market on the S&P 500, slightly firmer after a 3-day losing streak on the S&P, 4 days on the NASDAQ 100. We are higher this morning by 0.15% on the S&P 500. In the bond market, yields higher by almost 4 basis points. The 10-year 395.54. The next stop for the economic data a little bit later this morning, 8:30 Eastern Time, initial jobless claims, 8:15 the ADP report, the appetizer for the big one, the payrolls report just around the corner. The estimate at the moment, 171,000. All of that still to come. Just to finish on crude, TK, things are starting to pick up. Yesterday, again today, up by another 1 percentage point, just a grind higher in the last 24 hours, 73.43.
The Bloomberg Professional Service, as it's called, has green on the screen today. It looks a little December-ish, if you will, versus the 2 days of carnage we've seen in January. John, to that jobs report on Friday, I looked at, I think 15 survey points, and everything's just marginally shifted. It's just a sort of nuanced guesstimate of what we're going to see tomorrow.
Things have cooled in the last 12 months, but let's go through some numbers together. Claims today, 216 is the estimate. Payrolls tomorrow, 171 is the estimate. The unemployment rate may be coming in a little bit higher at 3.8%. Wage growth, year over year, something around 4. It doesn't scream end of cycle, does it?
Yeah, no, it doesn't. And, some people are looking for some drama, but what you just mentioned, John, I would go to wage growth and 4%. Is it going to get it done for Jerome Powell? Speaking of incremental, there's incremental action in Washington. They're maybe coming back to work. Edward Mills joins us. Ed Mills, Washington policy analyst at Raymond James. Ed, you've got a very domestic note today with domestic issues. John Farrow mentions the idea of our foreign wars. Is there a foreign policy stance among Republicans and Democrats on Capitol Hill?
Tom, they're trying to find that, and I think that they do wrap it from a domestic agenda. What we're looking at for a January agenda is not just funding the United States government, but it's the national security issues. And so you have the supplemental looming in the background for Israel, for Ukraine, for Taiwan. But Republicans are saying if we're talking about national security, we also have to talk about the border. So that's why Republicans were at the southern border yesterday, pushing for those border protections. But the problem for them is that they continue to lose members, and they're down to 219. Usually you need 218 to get something through the House. So they have really strong border policies, but right now they don't have the votes.
What is the Democrat Party view on a national security issue at the border? Do they agree? Is it a nuance? Do they flat out disagree with Speaker Johnson?
So I think it's a little bit nuanced. In the bill that failed in the Senate in December, there were some border funding provisions. What we have right now is that Democrats understand that they need to do more on the border. There's been negotiations, but they certainly don't want to go as far as House Republicans have been pushing for. They call it H.R. 2, the Protect the Border Act. That's real changes to asylum. That's changes to kind of e-verify systems in the United States. That's rebuilding the Trump border wall. Those are a step too far for Democrats. What I think we have to see is that Democrats have to go further than they're comfortable with to get the other provisions. but we are in that period of trying to figure out exactly where that line is. And so we're going to go right up to it and potentially have a government shutdown come January 19th or February 2nd, the two funding deadlines that are approaching very quickly here.
That's where I wanted to go, Ed. There seems to be a sort of a subtle shift in the Republican Party moving away from just tying some of the border kinds of security provisions to funding for Ukraine and Israel, to moving it more broadly, to shutting down the government if they don't get what they want. Does that make it so much more likely that we are going to get a government shutdown? It doesn't even matter.
It's a great question, Lisa, and I think that we're kind of right on that precipice of either grand bargain or bust, because we probably have to watch what develops in the Senate, but you do have this sense that Republicans want to fight, that they want to show that they are pushing for border security and want to push for more than what Democrats want, and sometimes by having that shutdown really elevates their point. However, Republicans also want to have the ability to say they got something done, that when they run for re-election here in November, that they can point to an accomplishment. And so that's where the grand bargain comes in. There is still a strong desire in DC to support Israel, Ukraine, Taiwan through a defense supplemental. And if you can put that all together, and we have to remember that even if we shut down the government, at some point we're going to reopen it. So it's just a question of how far and how much drama there is. But at Raymond James, we always do point out that in past government shutdowns, on average, the S&P 500 has been up by 3.2%. So from a market perspective, we kind of tend to discount the fact that the government could shut down because it always reopens.
Talking about drama, Donald Trump, we're talking about January 15th, we've got the Iowa caucuses, then we've got New Hampshire on January 23rd, where we have the first primary in the country. How much does it change the calculus if Donald Trump, as expected, wins the primary races in those two states, and we do get the sort of feeling that he, once again, is at the helm very much of the Republican Party?
So, Lisa, I think at that point, what you would see is that the voice of Donald Trump becomes even more important in congressional fights. Right now, a lot of the times when he sends out a message or sets a policy stance, it's noticed in D.C., but it's not truly followed. If he reestablishes himself as the head or the de facto head of the Republican Party and looks like it's going to be the nominee, then if he comes out and says, kill this bill, don't vote for this, you have to fight stronger on border security, that makes it much harder for Republicans to cut the deal. And so that's putting pressure to try to do it sooner rather than later. If they can get it done by that January 19th deadline, that is after the Iowa caucuses, but before that momentum could build. Alternatively, if you have someone like a Nikki Haley emerge, I think the markets would start to kind of surge because there is a sense that she is a stronger candidate against Biden, the likely Democratic nominee, and it gives a little bit more wiggle room for House Republicans and or Republicans generally in D.C. to potentially cut that deal.
That's the range of outcomes, Ed. You've got to tell me your base case for the next month. What do things look like?
The base case is drama, brinkmanship. It does seem like we could easily get that government shutdown, but from a market perspective, yeah, I tell clients to kind of pay attention to that longer-term provision. I do think we will get government funded. We will get a defense supplemental. We will get something on the border. It's just a question of timing, John.
Ed, thank you, buddy. Good to catch up. Happy New Year, sir. Ed Mills there of Raymond James. What a calendar. What a political calendar. Never mind the rest of the year. The next month. Lisa, the next 4 weeks, we've got January 19th, then February 2nd, and a ton of dates in between.
My favorite part is you asked him, okay, so you've got all of these potential outcomes and potential market-moving things. What's your base case? And he's like, I don't know. Maybe I just think things are going to
take a long-term view.
Yeah, exactly. I mean, this is the reason why it's like, what, staring at the sun? Is that what you said yesterday?
That's what Laurie Count-Vecina of RBC said about talking presidential elections at the moment.
I mean, that seems to be everything when you talk about government shutdowns. Okay, let's say we get a government shutdown. Does it matter? People will say yes until it happens, and then they'll say, yeah, it never matters. I mean, these are the kinds of things that we keep thinking about as we deal with some pretty massive dates and some pretty massive decisions.
The TK 2 key deadlines coming up.
Yeah, the key deadlines are there, but what's really important, Lisa, can you imagine John up to Freeport, Maine, get the LL Bean Act going down Route 95?
Do you know that I get so many LL Bean catalogs just because of you? You've mentioned
Your
this.
phone's listening to you.
I mean, seriously.
Yeah.
That's what's happening.
That's what
John,
happens.
I can
You mentioned it.
Can you see Farrell at the
send
New
me that.
Hampshire
You're
primary? LL
determined
Bean
to
duck?
send me that, yeah. I've noticed
He
that.
could get the wicker basket, you know
noticed
walk
that
around
too?
with a wicker
He just wants
basket.
to, see you decked out.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Three-day losing streak on the S&P 500, four-day losing streak on the Nasdaq 100 coming into Thursday. The price action this morning looks like this. Good morning to you all. Trying to bounce by 0.2% on the S&P, up by 0.2% on the Nasdaq. The small caps, the Russell, up by 0.7%. One single name to take a look at in the pre-market. Once again, it's Apple. And it's another downgrade, this time from Harsh Kumar over at Piper Sandler. The stock is down by just 0.6% after a struggle to start 2024. Lisa, the takeaway, the headline from them, valuation concerns and broader handset and macro weakness in the first half of this year.
The problem is that everybody's known this, right? They point to the same things that we heard from Barclays that everybody does seem to know, and yet still it's making an impact on the shares because people seem to be more concerned about valuations getting ahead of themselves, and Apple is the poster child for that.
Weakness, Tom. just not had the growth in iPhone sales against the multiple that's continued to expand, which is why Barclays pushed back early on to start this year.
Mid-December Nirvana near $200 per share. Let's call it down 8% right now. And as I mentioned earlier, on a standard deviation basis, this, let's be clear, this is worse than the general NASDAQ Magnificent 7 failure that we've seen.
Should we turn to the bond market? 2-year, 10-year, 30-year in Treasuries. Looking a little something like this on a 2-year. We're at 4.34. Yields up a single basis point. On a 10-year, 395.35. And tons of data out later. Lisa, we talked about how the ISM manufacturing has just been useless as a gauge for the broader economy. It's been sub 50 since late 2022. Jobless claims. One of the data points over the last year that just spoke to that resilience, that strength, still in and around 200K.
And people point to the fact that, okay, it creeps up to 216,000, things are going to fall out of bed. But here's the thing, are we reaching an inflection point? Are we just seeing a gradual normalization of a market that's been incredibly hot? And that, I think, is some of the uncertainty that people are trying to grapple with, and certainly what you're feeling in the market.
Claims data 2 hours away. I want to turn to foreign exchange just briefly. We can talk about the euro against the dollar. We can talk about the euro against the Swissy as well, TK, if you wish. The euro is a little stronger against the dollar at 109.56. The Swissy, in the last month or so, taking out, Tom, some really interesting levels.
Yeah, it can be domestic and an oddity of Europe where you look at Swiss against Hungarian forint because so many mortgages in Hungary are based off Swiss franc. Okay, that's an inside the baseball thing. But outside this, Swiss franc redowns on everything out there, including EM. And we burst through to new strength. A lot of technical analysis can be done on this. There's some, scuttlebutt. Oh, they own so much Apple shares within S&B. Maybe it's they're selling it into the weakness, whatever.
You're going to start that rumor, huh?
No, the rumor's out there. But, there's a lot of speculation. John and I lived this in Zurich years ago. We were at Brasserie Lee.
Should we do story time?
Yeah,
that's what we're doing.
We were there having a $200 lunch. And, well, back then it was $200. Now it'd be $300 lunch. And SMB acted with a vengeance. Will they act with a vengeance this time?
Let's do a 12, 13-year history of Euro Swiss, shall we? If we can just quickly in the control room get a chart of Euro Swiss up and take it back to 2011. So in 2011, Eurozone debt crisis, Swiss is getting stronger against the euro. It's a problem. Philip Hildebrand's leading the S&B. It's late August, early September.
Yeah.
The S&B introduces a floor for Euro Swiss of 120. Philip Hildebrand gets in a bit of trouble. We won't talk about that. Early 2012, Thomas Jordan takes over, keeps that floor until early 2015, which is when you and I were covering that story over in Switzerland, rips away the Euro Swiss floor of 120. The Swissy absolutely surges. And Tom, we trade in the 90s on Euro Swiss. And I can tell you that in the last month, Euro Swiss has taken out the levels that we dropped to when we ripped away that floor in early 2015. TK, that's how strong the Swissy is right now relative to where we've been.
The strength here goes into the Swiss economy, but far more, this is not like China where there's a gradualism in that. When they act, it's with a vengeance. I don't hear that speculation now, John, but nevertheless, that's the history from SNB.
Euro Swiss back in the 90s, and we don't know how many foreign stocks they're buying at the moment, Tom, so we won't comment on that. Under surveillance this morning, tensions building in the Middle East after nearly 100 people were killed in a blast in Iran. 2 explosions targeted a crowd, marking the death of a top general killed by a US drone strike in early 2020. No group is taking responsibility for the blast. The US State Department saying it has no reason, Lisa, to believe Israel was involved.
This has been one of the most confusing stories. The more that I read about it, the more uncertainty there seems to feel, because right now, US administration officials say anonymously that they don't think that Israel did it, that usually they act in a different way. Meanwhile, you've got Iran blaming Israel, blaming the U.S., some people saying maybe it's ISIS. There's all this speculation, but really it's unclear what even the motivation really is, because it is a different kind of attack. It is not targeted to one official. It is general public in Iran. And there is some Iranian anger right now from the population to the leaders saying, why didn't you protect us at this major event?
On the anniversary, Tom, of Soleimani's execution, assassination, going back 3-4 years, which is remarkable to think about. I just remember that January of 2020 when it just felt like we're on the brink of something big. And it wasn't a pandemic, it was this.
Yeah, I think Lisa gave a nice overview of it there, of Sunni and Shia and all the other niceties of religion and government as well. But it clearly rocked Iranian society on a Thursday.
I want to turn to this story as well, TK, just moving it over to Japan. Nomura boosting pay for young brokerage staffers by 16% in its next fiscal year. The Japanese firm boosting salaries far higher than local inflation amid competition for talent. This marks the first increase for young staffers going back to 2017. TK, we're talking about a once-in-a-generation opportunity to reset inflation expectations in Japan and drive wage growth. Are we starting to see signs of it?
Get out the calendar. This is really well timed as it's bone-eye season here in New York as well. And the Canardiers, the CEOs come out, you know, they like to come out on Bloomberg. They talk to Sonali Basak. We're going to be responsible and measured and cost control. Baloney. They got to keep the talent. That's all there is to it.
You want to talk about cost control? This is a perfect story then.
Yeah.
China, totally different story. Banks in China telling staff to cut travel costs. The moves include booking cheaper hotel rooms, and guess what? Drum roll, TK. Lisa, they're going to have to avoid business class flights. TK, what would you do? China's banks under higher pressure to reduce costs and raise margins in the face of bad loans and issues in the property sector. Authorities in China have already eased deposit rates and slashed reserve requirements, cutting costs in China, boosting salaries in Japan. Very different stories taking place.
Okay, how would you deal with, Tom, the Central Commission for Discipline Inspection in China?
For surveillance?
It's a good question.
This is the one for
Sorry,
surveillance.
I saw that name and I was thinking, if you had to report your Amex bills to the Central Commission for Discipline Inspection, how would that go?
Yeah, Redo Keeper of the Amex has something very much equivalent to that. Pro tip here, folks. We'd love for you to know about what the Zeitgeist is doing. George Magnus, of course, iconic at UBS, has been incredibly strong on Twitter the last number of days. I'll put that on Twitter and LinkedIn. George Magnus on China has been lights out.
Wrote a piece in The Guardian, I think, recently. Yeah, I read the same piece. Fantastic piece.
He's been very, very strong. Let's get to it right now. Sarah Hewen joining us. And this is something John Farrow has not forgotten about. I have. And that is Europe, the head of Europe and America's research at Standard Chartered. I want to digress here, Sarah, away from the U.S. economic data we're going to see. We haven't even addressed at the beginning of the year the challenges of Christine Lagarde. How are her inflation challenges different than those of Jerome Powell?
Sure that there are too many differences in terms of the challenges, because in both cases you have a strong labour market, and the question is, you know, is the Fed, the ECB, are they taking a different approach to those strong labour markets? We had a very, very clear message from Christine Lagarde at the last ECB meeting that domestic inflation pressures were the concern, that full employment and ongoing labour market pressures were a concern, and that's why the ECB is cautious, why they're not talking about rate cuts. The Fed's view seems to be, you know, we're getting a soft landing, inflation is coming down, we're not too concerned about labour market strength. But I would note what happens to wage growth tomorrow. We saw for the November payrolls report, average hourly earnings up stronger than expected. So that could be a concern going forward.
Well, let's go right there, because that was, I thought, the high point of your research note on wage growth. You take average hourly earnings, AHE, I bring it over to ECI, which is wages and benefits. What's the efficacy of AHE for you tomorrow at 8:30?
I think that, I mean, we are expecting a slowdown, to be fair. We think that we'll see softer monthly growth, but that's against a backdrop of last time around higher year-on-year, higher monthly, higher on a 3-month and 6-month annualized, all the sorts of measures that the Fed likes to look at. And the reason why I think it is still very much worth taking account of what's going on there is because the disinflationary forces that have weighed on inflation to date, goods inflation, imported inflation, commodity prices, we're starting to see those reverse now. We're seeing a pickup in commodity prices. Obviously, geopolitical factors are behind that. Higher freight costs, a real jump in freight costs when we've got used to seeing them really flatlining over the past year or so. And what central bankers will be concerned about is that you haven't brought your core inflation down far enough before the benefit from weaker energy and food prices starts to reverse, and your headline inflation catches up and starts to take over. So the wage earnings section is very important, not just for the Fed, but also for the ECB. But I would say at the moment, central bankers are taking a slightly different slant on what's going on and those fundamental drivers of domestic inflation pressures.
With that in mind, Sarah, when you compare and contrast, you and a team, the differences between the ECB and the Federal Reserve, how different are the thresholds for rate cuts? Who goes first? What have you penciled in for 2024?
Well, we do have the ECB going first. We think that they'll cut by the second quarter. They're shrugging aside weakness in the economy, but we think that that is going to become more of a factor. Obviously, inflation this time around for December is likely to nudge higher year on year because of base effects, but the broad trend is moving in the right direction. And ultimately, we think that by the second quarter, by the next set of forecasts that we get, I guess for June, they will be signaling clearly that there will be inflation on target over their time horizon. Possibly they get there a little bit earlier, but we do see a sort of more cautious approach from ECB. So we think second quarter rate cuts. For the Fed, we've got the third quarter factored in. But I have to say that the commentary that we had at the last FOMC seemed to be giving greater emphasis to perhaps the underlying growth of the economy and potentially the need to not over tighten or not hold rates too high for too long, which could suggest that they move earlier than the third quarter. Obviously, markets are expecting that they could move as soon as the next couple of months. We think that will be too soon. The minutes, I suggest, were more cautious than maybe than Powell's commentary after the last FOMC meeting.
That tug of war between market expectations and communication from the Fed continues. Sarah, great to catch up. Happy New Year. Sarah Hewitt there of Standard Chartered on the difference between the ECB and the Federal Reserve. Lisa, I think it was Citi's Andrew Hollenhorst yesterday who just said fine-tuning the message. The Fed minutes were fine-tuning the message after what we heard from Chairman Powell in the news conference.
And what does that mean? When it means, can you walk it back? You put the toothpaste back in the tube? The answer is no. Can we just say how much of a cover Jay Powell has given to Christine Lagarde? Basically, she could come out and say nothing, and she'd be looked at as the winner after Jay Powell came out with a message that roiled markets, because all she had to do was to sort of hew to this sort of vague message that nobody believed anyway, and the euro would get a boost, and they'd sort of, have some sort of lack of drama relative to Jay Powell.
I think that's a convenience that we have, that these central banks are linked, that Governor Bailey's on the red phone talking to Jerome Powell in Washington. How was your Starbucks
What other rumors are we going to start?
But the basic idea to me is Lagarde is completely distracted, like perhaps the collapse of manufacturing in Germany and the productivity of Germany, which is an arch change from where it was 5, 6, 7 years ago. Something like that looms a lot larger, and of course also the historic inflation battle as well.
The business model of the country, Tom. I'm pleased you mentioned it.
Yeah.
Complete rethink going on in parts of Europe about how best to move forward. Coming up shortly, Damien Sasser of Bloomberg Intelligence on China. Better than okay, TK, you know that. Okay. Equity futures on the S&P. Just about unchanged. From New York, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these